Here in New York City on this Tuesday, January 7th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, Nvidia shares power higher today after its CES announcements here. CEO Jensen Huang took to the stage in Las Vegas to unveil a new slew of products and partnerships. The biggest takeaways include the reveal of a new AI superchip, gaming graphics cards, and a new Cosmos platform for developing physical AI systems like robots and self-driving vehicles. Micron, Uber, Toyota, and Aurora are just some of the companies that stand to benefit from last night's announcements. Shares of those companies pushing higher today.
Plus, the U.S. has blacklisted gaming company Tencent and Tesla battery supplier CATL for alleged links to China's military. Shares of both companies slumping following the news and the decision threatening to escalate tensions between the world's two largest economies. Both companies protested their inclusion as a mistake, saying that they have no ties to the Chinese military. Tencent stock slid more than 7% in Hong Kong. That was the biggest drop that we've seen since October.
And Bitcoin retakes 100,000 for the first time in 2 weeks. The digital token powering higher after the certification of Trump's presidential win, with investors expecting regulatory reforms that should benefit the digital asset industry under the new administration. Bitcoin's record-breaking run in 2024 ran out of steam in late December, though, as investors looked to book profits amid a rally that took the token to $108,000 amid post-election optimism. Shares of Nvidia, ticker symbol NVDA. They are jumping this morning after CEO Jensen Huang's keynote address at CES in Las Vegas last night. Let's look at some of the highlights.
The AV revolution has arrived. I predict that this will likely be the first multi-trillion-dollar robotics industry. Humanoid robots, my friends.
All right, so new friends there. Our key takeaways from Jensen Huang's address are the gaming graphics cards, the new AI superchip, and the emphasis on robotics and self-driving cars. Now, if we were to go further and break all of those down and really on headline what it means for the stock price movement that we've seen over the course of the announcements, of course, in the tick-by-tick in the after hours, but then additionally here as we get closer to the start of trading here on the day, investors seeing enough to send shares higher by about 2.5% ahead of today's trading session here. A lot more optimism, it seems, and even more demand on the AI front that Nvidia is continuing to be the poster child for that trade right now.
Yeah, when you take a look at the street's reaction here, that moved to the upside about 2.5% here in the pre-market, on track to open the day above 153. The significance of this is Wall Street is really taking the commentary that we got last night from Jensen. The three big takeaways, Brad, that you just laid out there is the fact that they see this as Nvidia furthering their lead within this space right now, a space that they have long dominated now for the last couple of years. The big reason why we have seen such outperformance here from Nvidia, the company. A couple of things that stuck out to me. First, you mentioned the gaming chip. The reason why this was so interesting is because going back a couple of years, and I actually had the chance to be at Nvidia's headquarters several years ago, back in 2016, and a lot of that talk was surrounding gaming. And that's kind of been lost in the conversation, as obviously very much the investment story and the growth story has been surrounding the data center business. But we really saw gaming front and center last night. Right now, it makes up less than 10%, expected to make up less than 10% of total sales for this year. But questions about whether or not that new announcement last night is going to really supercharge that part of the business, what that ultimately means here in terms of taking that Nvidia story to the next level. You mentioned the AI superchip. I think lots of excitement surrounding that. You saw the great video that we just had up on the screen just about robotics, self-driving cars, what exactly that means here for Nvidia going forward as well. So those big three takeaways, I think, is adding to some of this excitement that we have seen surrounding Nvidia here the last couple of days, renewing that excitement in the new year. Now the big question is, how long is it going to take, and whether it's going to be enough here to get Nvidia to that $4 trillion market cap mark?
Yeah, absolutely. You heard some super engineering stuff too over the course of last night, whether it was talking about synthetic data and how that's going to be one of the more prominent features of generative AI, as there needs to be, of course, a lot of inferencing technology and inferencing and synthetic data going hand in hand, because there's a lot of scenario running that has to take place before a decision gets made by a generative AI, either bot or some type of output is generated. So all of that in mind here, you heard about that. You heard about some of the partners as well within this: SAP, Siemens for industrial AI, ServiceNow. I was taking a quick gander at some of those ticker symbols to see if there was some movement here pre-market. Not a ton, but at the end of the day, a lot of focus here just on Nvidia and the partners that they've been able to bring along for the ride, and really how they're showcasing the different tentacles of how they can deploy AI across different industries. And more broadly here, I think going forward for investors, let's remind investors, we're still a month plus out from the earnings report. So we're seeing even more of this kind of pull forward, at least in the mentality of how investors should be trading Nvidia until they report earnings, which is going to come at the end of February at this juncture. I think the 26th of February is when they report earnings.
Yeah, the one thing we didn't get last night, though, was any concrete sort of commentary surrounding the Blackwell chip, specifically just in terms of more concrete progress about the ramp that we could be seeing in Blackwell. That was one of the big question marks going into the night, going into the commentary. But it doesn't seem to be slowing down any of the excitement here this morning. So just one thing to keep in mind here throughout today's trading day. Let's stick with Nvidia. One of the big stories here this morning, shares of Nvidia jumping this morning after closing at an all-time high last night on Monday. Investors seemingly pleased by CEO Jensen Huang's keynote address at CES. So should you buy in now? For that, we want to bring in Paul Meeks. He's the Chief Investment Officer and Portfolio Manager at Harvest Portfolio Management. Paul, it's great to have you back here on the program. Let's talk about some of that excitement coming out from CES. How big of a catalyst do you see some of the announcements from last night being in the long term here for Nvidia?
Well, it's critical for Nvidia to show that when AI infrastructure spending starts to slow, and it's inevitable, it will slow at some point, that they have a plan B. And the plan B is essentially putting AI on board with their project digits, more and more capability for AI away from the data center and into things like the latest laptops and smartphones. And then also, I am pretty intrigued about the opportunity for the humanoid robots. But in the short, intermediate, and probably even multi-year term, the straw that is going to stir this drink is AI GPUs in the data center.
What is the new major growth frontier, you believe, Paul, for Nvidia, especially as they were talking about the future of autonomous vehicles being here, also talking about robotics as well here? Where do you give kind of the larger weight, and where you would like to see them spend even more to generate some of the partnerships that are going to bring more revenue down the line as well?
Well, I think you've hit two of the key areas. I'm not so bullish on AI on board in consumer electronics like smartphone and PCs, because I think at the end of the day, those will be features, not platforms. And features are typically commodity profit margins. I do think as we develop autonomous driving and as we develop the humanoid robots, those are two very large markets. So I would focus there.
So Paul, here we are at all-time highs here ahead of the opening of the session. Are you a buyer at these levels?
You know, I've owned the stock for years, so my average cost is so low, I am not. But if you were somebody watching this program, and if you had a technical analysis bent like I do when I time and pace my trades, the fact that the stock is going to puncture up through 150 on heavy upside volume is probably an indication that we're going to have another good year in this stock.
With that in mind, are there other stocks that could ride the coattails of Nvidia right now based on these announcements?
Yeah, the other stocks that I own in this space, some are actually competitive, Broadcom and Marvell, to allow some of these hyperscalers to design their own GPUs away from Nvidia. But I also own in big size TSM, which obviously is a derivative Nvidia play, and Micron.
Yeah, Paul, talk to me a little bit more about this. We have on the screen here, if we can flip back to the board that we were just showing, some of the names that are moving here this morning on the back of the announcements that we got last night. We have Micron, Uber, Toyota, Aurora, all tied up in the Nvidia trade here this morning. Any of those names stand out as a top play to you as we're trying to figure out who is best positioned to ride those coattails of Nvidia?
I've been buying recently both Micron and Uber because I've always felt that they would be at least a derivative AI play, and both of those stocks had been hammered as we got into the latter stages of 2024. So it's not necessarily that my fundamental view has changed, is that the stocks were relatively weak and actually had been underperforming, where the rest of this cohort actually ended 2024 with a flurry.
Paul, you mentioned that your cost average is so low on the shares that you hold in Nvidia. At what point would you even consider selling and taking profit?
That is an excellent question. So at some point you have to, right? I've been around a long time covering tech exclusively since the early 90s. What I'll be looking for is a slowdown in the growth rate. And the first time that you'll see a slowdown in the growth rate will be sequential quarter-to-quarter growth that slows down. Because if you wait for the year-to-year growth slowdown, you're going to get in there late. So I'll be looking for that sequential drop in the growth rate. Not necessarily saying you're going to have a fall, but to have a second derivative argument that we're growing at a lesser rate of change.
Paul, do you think Nvidia is going to get to $4 trillion this year?
That requires a stock to do about 30–40%. I don't think I'm bold enough to say that that's definitely going to happen, but I think over the next couple of years, I think it's inevitable.
With that in mind, as you're thinking about the real growth rate that you would expect to see, and if you do expect to see any deceleration in that growth this year, to what extent?
Oh, I don't think that you'll see the growth rate slow this year at all, because I believe that we'll have another year of very robust spending for AI infrastructure. So I have all my chips on the table there with the hardware and semiconductor vendors, including Nvidia. I have not been sold yet to have enough confidence that the AI software apps that are going to be at the end of the pipeline are going to be monetizable anytime soon. So I wouldn't expect to see this ultimate slowdown in Nvidia, which will happen in 2025.
Paul, always a pleasure to get some of your insights here with us. We're going to be tracking towards some of these all-time highs for Nvidia here at the Open. Appreciate it.
Best wishes.
Thank you. A U.S. dock workers union has set to resume contract negotiations today with ports along the East and Gulf coasts. The two have just over a week to hammer out the deal before the January 15th deadline. The core issue at the center of the dispute is automation, and the International Longshoremen's Association wants to stop further construction of semi-automated cranes here, arguing it poses a threat to existing jobs. Ports say the new technology helps keep them competitive here. Fully automated ports are already in use across China.
If a deal or extension is not reached, workers at 36 container ports handling half of the country's ocean imports could strike just days before President-elect Trump is inaugurated. President-elect Trump has previously spoken out against automation. Now, in a Truth Social post last month, he noted the distress, hurt, and harm the tech can cause dock workers. But his close ally Elon Musk has been critical in the past of the union's aversion to automation. According to CNBC, a secret meeting was held between union leaders and port owners over the weekend to discuss the automation issue before formal talks began. Back in October, the union strike lasted 3 days before reaching a tentative agreement. Coming up on a morning brief, we're going to count you down to the opening bell on Wall Street this morning. Plus, taking a look at Tesla as shares slump on an analyst downgrade. And Bitcoin powering back above 100,000. Can the gains hold? That's a big question. We'll discuss that and much more on Morning Brief.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator.
Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to talk a little Tencent here, blacklisted by the U.S. Department of Defense, adding that the tech giant is going to be going on a list of Chinese military companies here. Now, Tencent says its inclusion on the list is, quote, clearly a mistake. Battery maker CATL that supplies Tesla was also added to the list. The list doesn't carry specific sanctions, but encourages U.S. companies to avoid members here. This is specifically interesting as well on the CATL side here, given that there is some annexation to global EV makers like Tesla here, and they also responded saying that they were not engaged in any military-related activities.
Yeah, exactly. And I think the designation here impacts reputations, and that's one of the big worries here from Tencent and from CATL. And then moving forward, one of the risks here is that it could lead to Treasury sanctions. So I think that's why we are seeing such a reaction here in the stocks this morning here ahead of the open. When you take a look at exactly what this means, and you mentioned CATL here being a battery manufacturer here for Tesla, beyond that, they also have close ties with Stellantis, other large automakers like Volkswagen, just to name a few here. So again, any sort of backlash could obviously send ripple effects not only here through the U.S., some of those larger companies, but also on a global scale, just in terms of the potential backlash of what that would mean here for business going forward. But you're right, Tencent and CATL, they didn't waste any time in terms of coming out again saying that this was a quote unquote a mistake here, that they were included in this list, and they very much plan to test the reason as to why they were included and challenge that here from the U.S.
Yeah, reconsideration process that they can move forward with, and it may entail some legal proceedings as well here going forward.
All right, let's take a look at Tesla, because Tesla getting a downgrade at Bank of America was cut to neutral from buy due to its high valuation. Still, B of A raised its price target to $490. That was up from $400, reflecting some room maybe for upside here, but the case here is that a lot of this optimism has already been baked in. I want to pull up a chart that we've seen from Tesla, the outperformance. We've talked about it time and time again here since the election. And since the election here through today, you're looking at gains of just about 65%. And this plays into the call from Bank of America, because very much it is on valuation. They talk about the long-term potential for autos, for robotaxi, for Optimus, for energy generation and storage. But they're saying that this massive climb here, much of that potential upside has already been priced in at this point. They remain bullish as in terms of some of those longer term drivers. But again, when you take a look at at Tesla's reaction ever since even Trump's election, go back here to some of the optimism that we saw surrounding Tesla slightly before that, then just really speaks to how much of that has already been priced into the stock here today, and the fact that we're already trading just above $400 a share.
Yeah, from selling Sunset or selling the city to selling Cybercab. That's exactly what Tesla's trying to do right now. And it's got a bidder here, at least it seems, from John Murphy, who is one of the analysts here, saying that the robotaxi service actually offers an opportunity for the automaker and is looking for it to take on essentially 50% of its valuation. So that is a major call here for something that we thought we would see from Tesla back in 2020. Oh yeah, they had talked about bringing this Cybercab or a autonomous vehicle taxi service to fruition by 2020 as their marker. We are now 4-5 years removed from that. And so the larger question is, the number of states that have the decisions to cut some of the red tape and ultimately move forward with any of the use cases and an expanded period of testing in order to greenlight this for Tesla, as well as for some of the other autonomous vehicle services out there. Looking at you, Waymo, looking at what potentially Cruise Automation as a spinoff of GM could look like, we will see. But all of those things considered, Tesla is not going to be the only player if you do see some of that red tape start to get cut in an accelerated fashion here, which is certainly what Elon Musk may have the ear of President-elect Trump once he gets into office as well on that.
Some of those execution risks, which has been surrounding the stuff.
Yeah. Also, let's talk a little Meta here on the day. Meta ending its fact-checking program on Facebook. The CEO, Mark Zuckerberg, saying the company is going back to its roots around free expression. Listen in.
The recent elections also feel like a cultural tipping point towards once again prioritizing speech. So we're going to get back to our roots and focus on reducing mistakes, simplifying our policies, and restoring free expression on our platforms.
This comes as Meta adds new members to its board, including UFC CEO Dana White. Zuckerberg writing in a Facebook post that White has built the UFC into one of the most valuable, fastest growing, and most popular sports enterprises in the world. Other new board members include Exor CEO John Elkann and former Microsoft executive Charlie Songhurst. There you are seeing some of the profiles on your screen right now. I think more notably here with some of the new picks, the larger tenor that we're seeing is not even just what Mark Zuckerberg was talking about within that video in a cultural shift that, at least from his perspective, does elucidate an opportunity for them to back off some of the more strict content policies, but more so how he would like to have some of those same profiles who've been vocal supporters of the incoming president by his side and potentially locking arms as they're also trying to make sure that they stay in good favor with the incoming administration.
Yeah, you know, it's an interesting move. You have Dana White joining the board, obviously very close ties to Trump, like you were just laying out there. Also, Meta ending its fact-checking program. The reason why this is significant, obviously, some of the criticism that we've heard from President-elect Trump over the last several years towards Meta, towards Facebook specifically, towards Instagram, and Meta coming out saying that now they believe that they've gone, quote unquote, too far. So this certainly is a huge shift here, just in terms of what this means, how much of a play it is into this next administration. I think that's certainly is going to be one of the talks here surrounding this stock and surrounding some of the strategy here going forward. We know many tech executives have done their best here, or have at least made an effort to reach out to Trump to try to get in his good graces here, just considering how combative and how critical he was of some of those larger players within the tech sector during his first administration. But again, Dana White, just one of the names being added to the board here for Meta as we enter this year. They also added Charlie Songhurst, which you mentioned there, an investor of the former Microsoft executive. He already advises Meta actually on some of those AI products, so maybe that highlights a further push here into AI, something that's long been expected here on the street. And then John Elkann, which is an interesting pick here, Exor EV CEO. That's a holding company that has a family company that has stakes here in European businesses, including Ferrari here is one of those names. So again, adding 3 members to the board, bringing the total here to 13 directors, including CEO Mark Zuckerberg.
Yeah, this is not proactive at all from these companies here. And I think our own columnist, Rick Newman, had written about this and calling it essentially a kiss the ring moment for some of the major executives that are lining up to try and make sure that in reactive fashion to the outcome of the election, they are not out of the good graces of incoming President Trump, and that they don't see the same type of vitriol directed towards their company. Now, shareholders out there that are watching some of these moves, they're probably as well breathing a bit of a sigh of relief, hoping that their executives are making the right moves either to position the companies to be benefits of some of the incoming administration's prioritizations, whether that be on anything from energy all the way into social media. One thing or another you do not want to see is the president direct his attention towards you and it impact any ability to manufacture, secure supplies, or any of the the larger international partnerships that you've worked so hard to drum up. You don't want to see any of that rattled, and so the best way to do that is perhaps at least have a seat at the table with the incoming president.
All right, we got to leave it there, but keep it right here on Yahoo Finance. We are just getting started. We've got the opening bell for you in just a few minutes. We'll be right back. And here we have the opening bell on Wall Street. Let's do a check of the markets as we kick off a brand new trading day here. The first full week, I guess we could say, of January.
It's not even full.
Not even
full. We'll be off on Thursday.
You are right, yes, because of Carter's funeral. So I guess we'll have to wait till next week for that first full week of trading here, the exchanges here. But let's take a look at the major averages. You got all three of the major averages opening the day in the green. Some of the outperformance being driven by those larger cap tech names. You've got Nvidia at all-time highs here. You've got the NASDAQ in the green, up just about 0.4% as it calibrates there. The S&P also moving to the upside, the Dow moving to the upside there. Lots of questions about what it's going to take to keep this momentum moving to the upside. Who better to ask? Let's get over to Jared Blickery as a closer look at some of this movement that we're seeing at the open. Jared.
Thank you, Shauna. It looks like small caps are leading right now, although, it looks like small caps are leading for the second day in a row. I'm just going to show you the Russell 2000 here, and we'll look at 3 days into the year, and we can see up about 2% here, and we can even go back a little bit farther and look at the 1 month, because Russell 2000 was under a lot of pressure and saw a steeper sell-off than the majors than we had when we did get that Fed report last month, and that kind of surprisingly hawkish tone from Fed Chair Jerome Powell. So that's in the back seat here. But we also want to focus on the bond market. Now, 10-year yields are right near recent highs. I'm going to show you a 1-year chart so you can see the price action. Here we are, and it looks like we are actually at the highs right now, 4.63%, and we haven't seen these highs since basically last April, last May. And the important thing is, if we were to head north and go above 4.75%, that is another risk impediment. And so that's something we want to keep an eye on. We've also been watching the US dollar, which is a very similar story. Now, it is backed off of its highs. It did that yesterday, and it's just kind of treading water, not doing much today, but we will keep an eye on that. And let's take a look at what's going on in sector land, because we've had semiconductors assert themselves since yesterday. We did have Nvidia at a record high. We'll check out that in a second. But here we have energy. Energy is in the lead, second only to, real estate is second to it, and then we have tech. But as you can see, everything in the green here. By the way, crude oil just coming off a string of runs. We'll take a look at that in a second if we have the time. But here is the NASDAQ, and you can see Nvidia now. This should be another record high. It closed at the first record high in a while yesterday, and definitely the first of the new year. And you can see it has a long history of just consolidating and kind of moving to the next level and consolidating, although we didn't get much traction off of this rise in particular. So we'll have to see if this breakout leads to any place, or what Nvidia has done before. Sometimes when it makes a new high, it just goes back down and ends up being a bull trap. So that's something we'll keep an eye on as well. And checking out our leaders for the day, we see New York FANG. That's kind of the Mag 7 with a twist. That's in the lead. I was looking at IPOs there, solar, and then stocks. I want to take a look at semiconductors because these are breaking to the upside. Now, you can't necessarily see it right here, but there is a trend line. If you were to draw this right here, you can see this has some excitement with various traders. However, I think we really need to see a break of this horizontal level right there, that potential resistance level. I'd like to see this at 250 or more, and then it's kind of a note, it's probably fait accompli that it would be able to exceed those old highs. But semiconductors were a missing part of the rally late last year. They were kind of lagging, and so if we get that AI excitement again, you got to think that we could indeed be in store for another run, and we'll have to see what other stocks and what other sectors can tag along. Got to pivot to Bitcoin right now because we are seeing Bitcoin. It has been holding 100,000. It got up to 101, and indeed 100,824.27. So we've just seen Bitcoin kind of consolidate here, as we saw with the majors. We saw a potential head and shoulders top forming, but it didn't happen, and instead we're accelerating to the upside. S&P 500 closing in on its record high. We'll have to see if Bitcoin can pull the similar story there. Want to end in futures land where we have WTI crude not doing a whole lot today, but there's a longer term picture that I want to get to. So we're going to pull this up. It's actually up 1% right now. But crude oil is another instrument that has been trying to break out of a longer term negative trend line. It is not there quite yet. It's kind of right at the Rubicon, but if it were to accelerate above $75, that is going to change the game. I mean, we've seen this dollar, the US dollar gaining strength, and we talk about the dollar wrecking ball. When prices rise in the oil land, and especially in gas land, we feel that not only domestically, but it's felt abroad as well. So that's something we'll keep an eye on, and I'll send it back to you guys.
Jared, thanks so much. Appreciate the setup for today's trading activity. It's time now for today's strategy session. Bond yields have been on a steady rise this year, with the 10-year holding above 4.6%. So how high do yields have to go before investors begin to worry about stock performance? Joining us now is George Goncalves, who is the MUFG head of U.S. macro strategy. George, great to have you here with us. So
good to be on.
Absolutely. So when do we begin to see selling with bond yields, bonds yielding more than the S&P's earning yield?
Look, I think that the earlier segment with Jared and a lot of the points he made are really spot on. That 4.75 level on the 10-year would be a both psychological as well as an early warning signal that rates are going in the opposite direction than where the Fed wanted them to go. Let's remember that the Fed cut 100 basis points in a matter of 3 or 4 months, and rates went up 100 basis points, completely at odds and not really helping out the interest rate sensitive sectors of the economy. Housing was really looking for that sort of boost. Commercial real estate was looking for lower rates to help out their cause. And also, look, the small caps have had a hard time, and a lot of it has been on the back of this rise in rates. And so the rates channel will matter if we break above 4.75.
George, is that going to put a halt into this broader market participation story that we have long been waiting for? And I've started to see glimmers of hope about here, but they do fade quickly.
Yeah, no, that's also a great point, too. I mean, to kind of see a broadening out of the rally across different sectors in the equity space would make it feel like it's got more potential and more legs and become more sustainable. And so this is why that rate channel is super critical. I also think that the dollar will also be super important too. And then which industries are going to really be impacted first, depending on what sort of executive orders or sort of new policies that come out of Washington. And so, there's a lot still at play. I mean, we kind of, just joke around that this is the first week of the year, as we all know, and it's the first big macro week. But let's be honest, January 20th and onwards is going to be the start of 2025 in many regards, right? So I feel like we're in this kind of holding pattern still. As long as we don't break that 475, the dollar kind of stays here, then maybe we can kind of just trade sideways. But I don't see we accelerate one way or the other until we get more clarity.
What are the sectors to lean into when you see a holding pattern like this?
Look, I think being defensive makes sense. Look, utilities have had a good correlation with rates. Let's say rates don't break above 475. That would be, I guess, a way to kind of hold things out. I also think that the banks in general are benefit from the environment that lies ahead. Both from rates are going to stay higher than they would have been, all else equal, as well as there's hope for deregulation and just further lending and growth in that area. So I think the banks in utilities.
George, when it comes to some of those earnings growth expectations, technology obviously really front and center here when you take a look at the fact that the expectations here are for that earnings growth to reach just 18%. I say just 18% because that's in comparison to the 34% growth that we saw last year. How big of a risk do you see this posing or potentially being here to the broader market?
Yeah, look, having such a concentrated market as like we've had has both helped and potentially hurt us going forward, right? Because now we have this concentration risk around earnings potential, and and we have lofty valuations. Let's not deny that fact, right? And so I do think it does kind of goes back to your earlier point. If we don't see the broadening out of the rally, and we have this concentration risk, it does set you up for at least some sort of temporary pullbacks. And I think that's the risk for 2025. That a lot of euphoria post-election. A lot of euphoria that we're going to see this kind of momentum continue both in the economy and in markets. But what if a lot of that's priced in?
If we see growth deceleration, how would that then pass through to some of the right sizing of valuations?
Yeah, so I think it's going to be at the broader, larger indices, right? And I think that's where you're going to see most of the adjustment, be it the NASDAQ or the S&P. So that's really where you're going to see it first, front and center. But I do think that we are at a point where if interest rates were to come back down, that will give you some sort of relief. But yeah, there's a lot of factors up in the air, and I think that people have to have an open mind at this point, and look to try to diversify a little bit and not just be so concentrated.
All right, George, thanks so much.
Thank you.
Time now for our chart of the day. We want to send it over to Catalyst co-host Madison Mills, who has a closer look at broader tech versus chips. Maddie.
That's exactly right, Sean. I wanted to take a look at the underperformance that we have seen in the chip sector heading into Jensen Day at CES here, right? You can take a look here. Actually, as early as last week, the SOX index crossing a particularly bearish signal when it comes to technicals, but trading below its 50-day moving average over the past couple of months here, since you can see that low back in August. And yes, large cap tech has continued to outpace the broader SOX index, but we do see this tiny little tick up at the edge of your screen here. So will we break out of this technical pattern when it comes to semiconductors? That is going to be the key question to launch and look at today, especially after the slew of catalysts that the semiconductor index has had just this week alone. Of course, you had those Foxconn earnings indicating that AI demand is stronger than ever. That led to that initial lift on Nvidia heading into Jensen's speech. But we also had that big note from Citibank talking about 10 chip names to watch in 2025. And a lot of those names also rallied. And those are some of those smaller chips names that are going to make up the SOX index. It is not just Nvidia, of course. Now, you do, again, see that underperformance over the last 6 months. But I think the last thing that is important to note is something that Jensen talked a lot about, the idea of expanding that total addressable market. Something I thought was really interesting, the announcement of that $249 version of its Jetson computer for AI applications for smaller businesses. If Nvidia does something like that, it's not just a boon for Nvidia. It leads to a broader uptick of AI technologies, which could lead to a lift in some of these semiconductor names more broadly moving forward, guys.
Maddie, thanks so much. Appreciate it. Coming up, everyone, Bitcoin breaking back above the $100,000 mark. We're taking a look at what that means for crypto in the new year, 2025.
Bitcoin getting a boost here this morning, hovering above that $100,000 mark once again. So is now the time for investors to buy? Let's talk about the big drivers behind the recent rally that we've seen in Bitcoin and talk about how high it could go. We want to bring in Johan Kerbrod. He is Robinhood's crypto GM and vice president. It's great to have you back here on Yahoo Finance. So here we are this morning. You've got Bitcoin back above 100,000. What does this tell you just about the longevity maybe of that move to the upside that we could see for crypto?
Yeah, I mean, I think, the markets speak for itself. I think after the election that we've seen in November, a lot of people are a lot more excited to get into the space because there is this idea of regulatory clarity coming up. And it's not just going to be on the retail side, but we're also seeing on the institution side with news every day of companies going into the space. So I think, this is a very good signal and strong signal to show that on the mark of the 16th anniversary of Bitcoin, there is a lot of capacity for the price to move and for the assets to be used in a lot of different ways.
Yeah, speaking on price, Johan, when you see a strong signal such as this, what does that lead you to believe in terms of how high Bitcoin could run or cryptocurrency could run thereafter?
Well, I think what really tells us at this point is this is very early. We are starting to see institutions coming in just this past year, with the first ETF coming in the first half of 2024. And we are still seeing a lot of institutions not using cryptocurrencies for a lot of things. We are starting to see stablecoin being used more and more for settlements, for movements of fiat, but in a tokenized form. But I think we still see a lot of people waiting and seeing what is happening with the regulation. There is this idea that the next government is going to be a lot more friendly with cryptocurrencies, but at this point we still don't have clear rules and framework for the US. So I think there is a lot more that we have to see in the next few months before we can really decide how far Bitcoin can go.
I've been covering this industry long enough to know that there have been several psychological milestones that have needed to be moved through. And now that we've gotten past this most recent psychological milestone, the price of $100,000 per Bitcoin, what is that next psychological marker that is the make or break from your own purview for Bitcoin?
I think for us, what we at Robinhood what we really focus on is giving the right tools for our investor to invest in the assets and to look at it. One new tool that we launched in December was a tool called Robinhood Legend, which is a more advanced desktop and web platform for people to be able to invest in cryptocurrencies and multiple other assets on the platform. Bitcoin itself is part of this platform now, and we're seeing a lot of people being able to use it to understand a bit more the price evolution. You can actually implement technical strategy on it and technical analysis and see how far it can go. And I think people can use that and decide their own milestones. Because for everyone, every investor is different. Every investor has different strategies, and so we focus on giving them the tool for that.
There's been some talk or maybe some questions about whether or not we could be starting to see signs of a bubble, just how far and how fast Bitcoin has come. Any worry about that? And I guess what are you seeing just from the retail investor side of the story?
Well, I think Bitcoin has been famous to be cyclical. Like every 4 years, we've seen different variation. We also have what we call the halving moment, where the way the Bitcoin framework works is a bit different every 4 years. And so I think, we can see that. And so there is risk for every investment, as always, and that's why we are asking our customers to be careful and to always run their own research before investing in an asset.
Johan, I remember when Robinhood was going public, it was talking within its S1, it was talking very publicly about how important crypto is to the platform in its growth. Now that you've seen these major milestones marked for the cryptocurrency and you have an incoming administration, which to your point seems more crypto friendly, where does that sit in prioritization for Robinhood now versus a few years ago?
Well, I think actually Robinhood was always very excited about cryptocurrency. If you think about when we launched cryptocurrency was in the winter of 2018, which was really the bottom, like the last bottom of the last bull cycle. And at the time, a lot of people were saying that Bitcoin and cryptocurrencies were kind of like dead assets. And, at the time, Robinhood still decided to launch cryptocurrency because they felt like this was an important asset to offer for a portfolio for our customers. And since then, we've been improving the system and all the features that we offer. We added more assets, we added more features, and we are going to keep developing on it. And it's really part of Robinhood. We want to make sure that people can access every asset that they're interested in.
I guess in those end users, are you finding that your crypto users are contributing more to the average revenue per user that you're seeing versus equities or options even?
It will really depends of the time of the year and how the market is, and is it more of a crypto market, is it more of an equity market, or is it even something else? And really for us, it's less about thinking about how do we share within the company, and more how do we grab market share within the industry.
Johan, thanks so much for taking the time here with us today. A lot of great insights. Thanks. All your markets action straight ahead. Stay tuned. You're watching the Morning Brief.
It's time for Yahoo Finance's Market Minute. Stocks edging higher with labor market data on deck. That job openings and labor turnover report for November out at 10 a.m. Eastern. Apple downgraded to sell from neutral at MoffettNathanson. The analyst citing concerns in China, implications from the U.S. lawsuit against the firm, as well as lukewarm iPhone 16 sales. Apple is down over 2% since the start of 2025. And Tesla also getting a downgrade this morning, cut to neutral from buy over at Bank of America. They cite its high valuation. Still, the analysts behind the call see some room for upside in the stock, raising its price target to $490 from $400. Plus, Getty Images and Shutterstock are merging. The two companies plan to create a business worth $3.7 billion. Getty Images CEO Craig Peters will serve as CEO of the combined organization, saying of the merger it will enhance, quote, content offerings, expanded event coverage, and deliver new technologies. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
All right, Maddie, thanks so much. Brad, when you take a look at that, let's talk about the last market minute.
The match made in image heaven?
Potentially here. Could face some antitrust scrutiny, but we know that these two companies had to do something because their stocks have been under pressure now for quite some time, and they're trying their best here to compete in this new AI era.
Yeah, I mean, anytime you have some of the image generation, especially for anyone who has licenses through softwares like Adobe out there that are going to pay into that added tier, most likely to be able to create an image of a gecko snowboarding down a mountain, also sipping a can of Coke at the same time.
The things we need.
The things that marketers and advertisers need to cut out some of the costs that they're paying agencies for. Sure, yeah, that's exactly what this could be, a very detrimental hit to Getty and for Shutterstock. And so I think for Shutterstock as well, I've been able to interview some of their executives South by Southwest a couple years back, and they were already thinking about AI. They were thinking about this, of course, existential threat for their business. We'll see if this helps them stave that off.
And how much it's going to help enhance some of their content offerings. All right, that does it for Morning Brief. Coming up next is Catalysts. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills, 30 minutes into the U.S. trading day. Let's get to the three catalysts that we're watching this hour.
First up, JOLTS data crossing the wire now with the latest read on the labor market ahead of Friday's jobs report. What the economic data tells us about volatility ahead.
Plus, Nvidia moving to the upside after CEO Jensen Huang announced a slew of new AI products. We'll tell you what other chip names could benefit from Nvidia's move to the upside.
And 3 stocks to buy under Trump 2.0. We'll get you those tickers right here on Catalysts. Let's take a look at some market headlines to start the hour, sponsored by Tasty Trades. Starting off with the major averages, we are still in the green in the S&P 500, up 0.3%, but really interesting to note, this is so important today, the NASDAQ turning negative because we're seeing Nvidia turning negative, erasing its earlier gains after hitting a record high since the month of November. Now we are seeing the shares of Nvidia down a little over 2%. Of course, we will continue to monitor those moves. I want to flip the board over to Treasuries if we can, because I believe we are seeing a little bit of movement to the upside. The 10-year yield up just about 2 basis points this morning, hitting that 4.6 level could potentially pressure equities more moving forward as well. And finally, I want to take a look at Bitcoin here under a bit of pressure as well, down nearly 1%, just below that key $100,000 level.
We have some breaking job openings and labor turnover data crossing the wires right now. When you take a look at the openings, coming in at 8.09 million, that was well above survey expectations, also well above the prior reading that we did get on JOLTS, the job openings data here. Obviously very important here ahead of the huge labor market print that we will be getting at the end of the week. The prior month was also revised to 7.84 million. That was up from 7.74 million. Job openings rate was 4.8% in November. That was versus 4.7% in the prior month. In terms of the number of people quitting their job, actually ticking just a bit lower, it looks like here for the month of November, coming in at 3.06 million. That was versus 3.28 million the prior month there, with the quits rate right around 1.9% versus the reading of 2.1%. But again, when you take a look at the job openings number, they're rising to 8.098 million, exceeding the street's expectations, Maddie.
It's interesting that the quit rate fell back to that 1.9% level, perhaps an indication that folks are holding on to their jobs a little bit longer. It's pointing to this sign of not necessarily weakness in the labor market, but a little bit of cooling that we have been sensing under the hood, especially when you take a look at that broader quits rate, again, coming in at 1.9%, the prior release being 2.1%, and also that layoffs rate ticking up just a touch, coming in at 1.1%. The prior reading was just 1%. So when you take a look at those two data points in tandem, perhaps just a little bit of that softness under the hood in this labor market data, something that we'll continue to monitor. This typically doesn't move the market more broadly, but a lot of individual names moving the market today as well.
Well, this morning's JOLTS release is the first of a slew of economic data prints in the coming days. Our next guest warning that those releases could potentially be catalyst here for market volatility. Joining us now, we want to bring in Jeff Jacobson, head of derivative strategy at 22V Research. He joins us now. Jeff, it's great to have you here. So you say investors should brace for more volatility ahead, especially off the back of some of the economic data prints that we have up on the screen right now. Talk to me about the why factor. What's driving that prediction?
Yes, absolutely. So, we've seen volatility pick up in the market over the last, call it 11 trading days. We've seen realized moves in the market almost around, let's call it 0.75% on a daily, on half the time on a daily basis. So what that's doing is pushing up the realized volatility. At the same time, we've seen the VIX come down from the December highs when we hit the high on the last FOMC report. So you're getting a scenario set up here where implied vol, or the cost of buying protection, has come in, yet at the same time we've seen realized volatility move up. Now this is coming at a time ahead of, to your point, all the key economic data that we will be getting over the next few weeks, whether it's payrolls, the inflation data on CPI. We have another Fed meeting at the end of the month. So, we have plenty of opportunity, if that's the right word, to where we could see heightened volatility. And certainly, if we get the moves in the bond market that would go against, higher yields, which would go against favoring stocks here, there could be a setup where we could see, a decent pullback after this brief rally that we've had over the last few days.
So obviously a ton of economic data ahead to watch, but what do you think are the key catalysts for volatility moving forward from that slew of economic data?
I think it's going to again come back to the bond market. We had the 10-year yield up to about 4.65. The highs we hit in the last year and change were 4.7 and 5%. We're at 4.65 now. When we've hit those levels previously, we saw a decided pullback in stocks. That hasn't really been the case here for the S&P. We've seen other parts of the market, obviously the more interest rate sensitive parts, small caps, come in, and the large caps, the S&P, have held up very well. My guess would be that, if we get a move back north of 4.7 or higher on the 10-year, that may be the trigger where we could see that volatility that I was speaking of.
And we just have that, we have it up on your screen just in terms of the pullback that we do see in equities as we do see yields hit those levels here. Jeff, as we talk about then what investors should do at this point, we have a real risk here. We could see yields very soon eclipse that level. What is that top trade then to protect your portfolio?
Yeah, like I said, it's a great setup in the sense that the cost of insurance has come down, like I said, from the December highs. At the same time, where realized volatility is coming up. That's a great opportunity to buy, just straight out SPY puts, in my opinion. You can buy, the trade I suggested in my note was buying the February 7th SPY put, the 582.50 put. It's about 2% below where the market's trading now. And you have a month that will capture all the economic data I mentioned, the Fed meeting, earnings season for pretty much, most of the large cap names, the banks, the industrials. So I don't think you're going to see a real decrease in implied vol because A, realized vol has been moving up, like I said, and B, you have all these upcoming events and catalysts that could trigger, weakness, especially if we start to see yields move much higher. So, I like buying puts outright here, and if we do get a move lower, not only will you be able to monetize those puts, but it'll obviously act as a nice portfolio hedge for if you have large cap exposure, which most people do.
You mentioned that key Fed meeting coming up here, just crossing the wire. Traders are no longer fully pricing in a Fed cut before that July meeting. Jeff, how much volatility might that cause? And if we do see a lot of buying of volatility, does that indicate to you kind of a bearish swing in the market?
Yeah, I mean, I think that certainly if you remember, we had, quite a large move in volatility and the market the last Fed meeting, specifically when, Powell was speaking. I think you're going to start to see a relative bid to volatility again into that meeting, which is why I like kind of getting ahead of it here and owning vol. And certainly, I think, again, however the bond market will react to the meeting and the events leading up to it will probably dictate, how stocks do from here, especially the large caps that, again, have held up, very well in the face of rising yields.
All right, Jeff, we got to leave it there. Thanks so much for joining us.
Thank you.
The dollar is still under pressure today after President-elect Donald Trump refuted claims that he plans to pare back his tariff plan. Our next guest names policies like tariffs as one of the key downside risks to the economy this year, alongside immigration and taxes. For more on his outlook, we have Tony Roth, Chief Investment Officer at Wilmington Trust. Tony, great to have you. What do you make of the stickiness of the market's reaction to the back and forth on tariff policy, specifically when you take a look at the action on the U.S. dollar?
To be honest, I'm actually surprised that the markets are attributing as much significance to the rumor mill right now in the news cycle on tariffs. I think it's pretty clear from the past action that the former president had in his prior administration and what he's trying to accomplish right now, that he wants to maintain his powder, if you will, his dry powder from a negotiating position, and is not going to be rushing in before he even gets into office with a narrative of lower tariffs for these trade partners. It's pretty clear that what he's trying to do is improve our economic position through the use of the tariffs by opening other markets. Now, that doesn't necessarily happen overnight, and it could be that we need to endure a little bit of pain with higher taxes, effectively, higher tariffs on imports before we get to probably open some of the other markets. but he's not trying to create a scenario here where we're going to have an ongoing tax, if you will, for a long period of time. So I think we've got to take it all with a grain of salt. And I'm a little surprised, frankly, that the markets are ascribing as much importance to, again, this sort of 24-hour rumor cycle mill on what he's going to be doing with tariffs right now.
So then just in terms of the expectations or what this could then do to the growth trajectory, it sounds like maybe some of those fears, are they a bit overblown?
I think that we have to take seriously the worst case as investors. And we have to look at it, and we have to sort of be anchored to that as a possibility, even though we may not be investing for it. So if, in fact, the administration were to move forward with everything that's been talked about, we would see tariffs move as a percentage of imports from 2% to 19%. That would be punitive. That would throw the economy into recession, et cetera. So someplace in between those two points is where we'll end up. And we just have to be patient. We have to stay invested. There are a lot of other factors that we think are going to be positive for the economy in our outlook, like, for example, lighter regulation, like the potential to open other markets, potential for fiscal stimulus if they're able to do a very long continuing resolution on the debt ceiling, or just push it off for the term of the administration. And so it's very important to stay invested, but then to keep an eye on these issues that could be the shoots, if you will, in the economy to the downside. And we don't have a lot of informational content yet.
Another shoot that you mentioned was valuations, and I wonder if kind of the growth backdrop that you're mentioning being under pressure could potentially get rid of the valuation problem as well.
Well, I think the valuation problem is here to stay, in the sense that at some point we're going to have to see a correction, whether it's a recessionary correction or a non-recessionary correction. We'll see. When I say at some point, I don't necessarily mean a 20% correction in 2025. Would I be surprised to see that happen? No, not at all. But at some point, we're going to need to see valuations normalize. We're in the 99th percentile when we look at a lot of the key metrics. So I don't think the valuation problem is going away. But having said that, when we think about our base case for the year, which is probably around a little bit less than 2% growth in the economy, we don't see a catalyst for a recession. And in that kind of environment, notwithstanding the valuations, we would expect to see probably high single-digit returns for U.S. equities. So it's a tough environment, because if we did have a 20% return this year, it's much more likely to be down to the downside than the upside. So you've got that left-hand skew in the distribution. But at the same time, the more likely scenario is an upside sort of single-digit return in the equity market, which stands to be a lot better than bonds.
Tony, what would cause that investor sentiment shift? I think that's the big question. Outside of the recession factor, obviously that would really drive a shift in investor sentiment right now. But beyond that, is there anything else that investors should have on their radar that maybe could provoke some sort of reaction that we could see play out in the equity market?
Well, I do think that the tariffs, to start, as we can see, are a source of volatility in markets. Whether it's a continuing source, I doubt it. But again, we don't want to exclude that as a possibility. So I think that's probably the number one factor right now. The second factor I would point to, which is very much not our base case scenario, but it's inflation. So I think that when we look at the economy, we definitely see an economy where we see very persistent disinflation. We think that we're going to be at 2% by the end of the year, notwithstanding some of the recent stickiness in core inflation, which we think had a lot more to do with weather and strikes and such at the end of the year. We're pretty confident, actually, that inflation is going to be coming down, and that we're going to see the Fed probably cut more than the Fed has indicated in the dot plots or the market is indicating. But having said that, we could be wrong, and if inflation doesn't come down in that way, that could be a real drag on market sentiment as well. So I think tariffs and inflation are the two biggest things. And then beyond that, smaller things, maybe geopolitical relationship with China, Taiwan, things in that area, if you will. But I don't think that those are really going to be too pronounced. I actually feel that the geopolitical situation has abated to some degree, because I think that we're probably closer to the end of the two conflicts that we have in the Middle East and in Ukraine and Russia.
All right, Tony, always great to get your insight. Thanks so much for taking the time to join us here this morning.
Thanks for having me.
We've got much more coming up on your market action ahead. Stay tuned. You're watching Catalyst. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of this session. All done with Yahoo Finance's trending tickers page. First up, let's take a look at Nvidia shares actually reversing course this morning. The move lower coming after the stock hit an all-time intraday high. You're now looking at losses of right around 3%, hovering right around the lows of the session here this morning. And this comes after the initial pop, which followed CEO Jensen Huang's keynote speech at CES last night. Here with more, we want to bring in Kunjan Subani. He's an analyst with Bloomberg Intelligence. It's great to have you back here on the program. So we initially saw some excitement play out in the street just in terms of what we heard last night from Jensen Huang and some of the ambitions here and plans for new products from Nvidia going forward. Yet here we are right now this morning with a loss of just about 3%. How should investors, how should our audience be looking at this drop?
Yeah, I mean, to sum up the keynote and the key impact on the stock, the announcement and the launches, both across its hardware and software stack, continues to strengthen its already strong moat when it comes to GPU leadership. Now, most of these announcements are not going to most likely impact the near-term financials. That's why you might be seeing some softness. But what it does create a long-term tailwind, keeps its stickiness intact, and sets it up to dominate in the next wave of AI spending as we transition from training and to a lot more inference, and as we transition AI from data centers beyond into PCs, automotives, and the edge.
I just want to get your take on the market action that we're seeing. Obviously, Shauna mentioned Nvidia under pressure after hitting that record high, but also the SOX index down nearly 0.9% at this point. Do you anticipate what you're hearing at CES to eventually be a lift to the broader semiconductor names?
I mean, CES is important, but if you keep in mind, really, the focus really here is on consumer products and automotive and IoT, right? Most of the excitement in the SOX last year was driven in the data center markets, so not really a data center conference. But we think this does set up for especially the AI into PC, AI into edge. The announcement that we heard and we are going to hear should set up some excitement going into 2025, especially on the AI PC that we believe will start to show signs of a ramp this year.
Kunjan, you're at CES. Just give us a better sense of what the reception was like among your colleagues and really what this tells us then about maybe some of the other plays that could potentially benefit from the updates that we heard from Nvidia last night.
Yeah, so, the beneficiaries from NVIDIA's keynote were a couple of names that were showcased as beneficiaries of its new products. One was the memory supplier Micron, the other was MediaTek. So these two names could see potential financial benefits as these NVIDIA products ramp. And beyond just the consumer side, beyond these two announcements, there's a lot more excitement and competition when it comes to AI PCs. NVIDIA announced two of its hardware products which support the PC and sort of the AI computer. One is the mini AI computer and one was the Blackwell GPU cards for consumers. We saw a lot more announcements from Intel and AMD and Qualcomm as well. So this area we think is going to see a lot more intensifying competition as well as potential to start a ramp in 2025.
Yeah, it's interesting. I know when we spoke a little bit on the phone earlier, you mentioned Broadcom and Marvell as two stocks that could see gains off the back of this. Talk to me about your base case for those names.
Yeah, so in data center, server, GPUs, and accelerator, what NVIDIA has done is it has accelerated the cadence going from your typical 18 to 24 months product upgrade to now 12 months, and has increased performance at unprecedented speeds. What this has done is created an opportunity for a lot more spending and upgrades when it comes to data center networking and connectivity chips. And so names like Broadcom and Marvell, who dominate this space, are seeing already advantages of that as the customers of NVIDIA are spending more money to upgrade and buy newer and more expensive chips from these two companies. We also have newcomers like Astera Labs, who you didn't talk about 2 years back, but now is seeing a lot more benefits because as consumers of NVIDIA buy a lot more data center GPUs, they need to go and buy a lot more networking and connectivity chips that perform as fast and extend the reach for these GPUs.
All right, Astera, Broadcom, and Marvell, the stocks to watch, among others that you mentioned for us, Kunjan. Thanks so much for joining us. Appreciate it.
Thank you.
Also want to take a look at Roku. Shares moving to the upside after the company surpassed 90 million streaming households in just the first week of January. This indicates a 4 million household addition in its fourth quarter. You can see shares up 1.5%, but earlier in the pre-market, they were up over 5.7%. Bloomberg Intelligence saying this morning this indicates, again, 4 million additions in the fourth quarter, but also improved monetization that could anchor 2025 gains. So they're really kind of broadening it out to a bigger growth story for the year here.
Yeah, and I think that's why, or maybe that justifies this move higher that we are seeing here in early action. When you take a look at this name, it hasn't done too much over the last month. We have shares still in the red, but when you take a look at maybe a little bit of a longer term chart, you got the 6 month chart as well. That's showing gains of just about 30%. So we are seeing just the streaming dominance here from Roku. When you take a look at these numbers here that we are getting out this morning, the fact that they did surpass 90 million streaming households here in the first week of January, that indicates 4 million new additions here in the fourth quarter alone. So again, when you talk about the momentum heading into the new year, I think that very much explains some of the growth trajectory and the optimism surrounding this name here, just in terms of maybe those additions that we could continue to get here in the months to come.
And potential new catalysts.
Yeah, well, we'll see. There we go, playing into the name. Right. All right, Paramount Global is renewing its distribution deal with Comcast, allowing television channels like MTV, CBS, Nickelodeon to continue airing on Comcast's Xfinity cable service. Here with what that means for both companies is our very own Alexandra Canal. Alex.
Hi, yeah, so it's an interesting moment, right? In traditional television, we have a lot of folks going over to streaming, cutting the cable cord. But I think what this deal emphasizes is that there's still a lot of folks on cable. And what this allows, this new carriage agreement, like you mentioned, those Paramount-backed networks like CBS, Nickelodeon, BET, that's going to continue to be available to Comcast Xfinity subscribers. Those subscribers are also going to have access to the streaming platforms, so Paramount Plus, Pluto TV, and BET Plus. So really it gives consumers the optionality, the ability to have access to those streaming platforms along with those traditional cable networks. So Comcast really wants to continue to provide those customers that optionality, that flexibility. And then on the Paramount side, they want to continue to make sure that their content is reaching as many folks as possible. So another good reminder here that we talk about cord cutting a lot, but still a lot of people have those cable subscriptions.
Well, speaking of cord cutting, another story that you're watching for us, Netflix, with the Raw program last night.
The first debut, WWE, Monday Night Raw.
I'm not a core demo for this programming, but clearly people are into it. Allie, what do we
You know what's funny? I watched this when I was younger with my brothers. I can't say I'm a fan today necessarily. However, I did tune in for that nostalgic factor and just going around X talking to some folks, it seems like that was a thing. People that hadn't watched these types of programs in years went on and watched it because it was on Netflix. So it has that accessibility, that scale. There's a lot of people that have Netflix subscriptions. So this provided that opportunity. I gotta say it was a star-studded event. Some familiar faces, The Rock, Hulk Hogan, John Cena, even in the audience. We had people like Travis Scott, Vanessa Hudgens, Macaulay Culkin. So it really did feel like this nostalgic moment. A lot of people were excited about it. We're still waiting on those viewership numbers, but I think how successful Netflix has been with their NFL programming, with the Jake Paul-Mike Tyson fight, I think it just emphasizes the power of Netflix here. There didn't seem to be any glitches. The stream seemed to be stable. So it feels like the more Netflix experiments with this type of programming, the more comfortable they are with airing this type of content and hopefully without any types of glitches. The stock is up about 85% over the past year, so certainly a high bar to cross in 2025, but I think with continued success when it comes to these live events, especially when you think about the advertising impact and the flywheel that could create and the boon that could lead to Netflix's stock, along with some more must-see content like Squid Game 2. I binged it already. I was obsessed. I loved it. I think investors are going to continue to pile into this stock. So I think the fear, though, is that maybe the valuation is too high. We'll have to continue to wait and see.
Yeah. They're playing to loyal fan bases, that's for sure.
That is true. That is true.
As the mom of all boys, WWE is probably going to be on my TV before I know it.
Especially now that it's on Netflix, Shauna.
Well, our apologies to you, Shauna. But thank you, Allie, for joining us. Appreciate it, as always. Coming up, building a portfolio for Trump's second term. We've got 3 stocks you might want to consider buying next. Keep it here on Catalysts.
Less than 2 weeks to go until Inauguration Day. Wall Street is gaming out the top stock plays for a second Trump presidency. Our next guest says that there's 3 stocks winning under Trump 2.0. Here to walk us through his calls on Tesla, Amazon, and Palantir. We want to bring in Joe Teague. He is Rational Equity Armor Fund's portfolio manager. Joe, it's great to have you here on Yahoo Finance. Let's walk through these top plays you have here and start with Tesla, because this is a stock that has really outperformed since Election Day. We've got that chart on the screen right now. We're looking at gains at 65% since November 5th. Walk us through why you still see that as a winner in the year ahead.
Yeah, so we're seeing a little bit of a risk off day to day, that's to be sure, but I'm more looking big picture on all 3 of these names. I think it's interesting, looking at the market right now, it's soft because the economy was so strong. That doesn't make sense to me. I think with a accommodative Fed, a strong economy is going to be good in the long term for these stocks. So these are just going to be names we'll be holding for the long term in spite of any hiccups like today. But for Tesla, yes, I do like their Model 3 and Model Y. I think they're leaders in the EV world, and I think new administration could be favorable to them. Now, we had talked about, prior to the election that the Trump presidency would be less favorable towards EV producers, but I think that'll hurt the big 3 a little bit more than Tesla. They're already entrenched in that environment. They're the leader in that space. I think they are going to be the winners, actually, if there's less EV spending, because they'll be the last one standing, of course. So I think that's true. And of course, there are other areas that Tesla is looking into and getting into. First and foremost is their battery. I think that's going to be a big player going forward in the next 4 years. Just how important that battery is going to be for all of the energy that we're going to need, the renewable energy. So I think that is potential revenue stream, which, for my money, I don't think Tesla is justified their valuation here as a car company. I think there's so much more that they're going to bring to the table, which they're going to need to do, which I'm excited for the next 4 years.
Yeah, as you mentioned, there's a bit of risk-off sentiment pressuring these names today, but Tesla in particular also had some negative commentary from Bank of America this morning. That downgrade also adding fuel to the fire with pressure on the stock. What do you make of that downgrade and just the negative commentary around Tesla right now?
Yeah, I mean, if you look at it as a traditional car company, it doesn't make sense. I think everybody can understand that. It needs to have so much more going forward. And I think that's where, a leader with a long-term goal is where you'd like to be. I think that's so a lot of the companies I like to invest in have that founder in place, not looking at the next quarter, not looking needing to make profits right now, with a longer term vision with where the company's headed. And that's why I like these companies broadly.
Well, let's talk about one of the founders here of a larger tech company here that has been trying to cozy up, or at least repair maybe a damaged relationship with President-elect Trump, and that's Jeff Bezos here, executive chair of Amazon. When you talk about Amazon being a top play under Trump 2.0 presidency, what does that catalyst look like, and why is now the time to buy?
Yeah, so famously, they feuded in his first presidency, and it seems like Amazon this time around is attempting to be on more favorable conditions. Prior to the election, there was news and reports about companies owned by Bezos being a little bit more favorable. I think we know Washington Post declined to have an endorsement. I think that was viewed as favorable towards Trump. And since then, we're seeing even more policies which are viewed as favorable to him. You look at, the headlines recently about Prime having documentaries on Melania. Now, that's getting into the weeds, but I just think in general, Amazon wants to have a favorable relationship with this administration because there's big money to be had, specifically in the cloud services. There's, military spending. There were major contracts that were awarded to Microsoft, not Amazon, last time around. So I think Amazon wants to be in the mix. Now, all that said, Amazon's going to benefit in other reasons too in a new administration. Tariffs around the world are going to be costly for a lot of companies, but Amazon's infrastructure is so diverse, they can find places where tariffs are less impactful and be able to capture some of that gain for its consumers. And Amazon also is going to benefit if there's any corporate tax reduction too. So I think there's plenty of reasons to like Amazon, even outside any connection to the administration.
There are also concerns about Palantir's valuation in the tech space. Why is it still worth buying?
Yeah, so another company, huge run up after the election. Actually, most of that run up started right before the election off of their fantastic earnings. This for me is, yes, it's about the founder. Yes, it's Karp being the founder. There is a connection with the administration, of course. I think this company does get a lot of government business. But for me, this is kind of the software innovation of the AI world for me. We know about the AI infrastructure building out. We know about the data that's going into it with all the Mag 7. That is what everyone's talked about so far. We haven't seen a new software company really come onto the scene other than Palantir. So for me, this is putting that AI to work. How is it going to benefit people's lives in the near future? Palantir has the products. I think this is an exciting company for me. Yes, it has a high valuation, but it doesn't seem crazy unjustified. They have a ton of cash on hand. They're making money. I think they could ramp up and generate even more growth, but they're kind of being cautious, biding their time, waiting for the right time to do so.
Joe, let's talk crypto, because that certainly has been back in favor now since election day. You've got Bitcoin back above 100,000 here this morning. Are investors getting a little bit too ahead of themselves, and why or why not?
Yeah, so I love the technology. I love crypto. I love, Bitcoin is an amazing ingenuity. I've been interested in it for a long time, but I'm just cautious at these prices. There isn't really a valuation for crypto. It's just a price. Now it makes sense, on paper. It makes sense, digitally. I guess it's not really a paper at all. But the risks for me are very high. Now, normally, since World War II, the United States has been the world reserve currency. Now, people decide that the United States paper money is valuable, mostly because, their economy is so strong, but also their military is very strong. At any point, if there were a conflict, people say, I think the U.S. would win it. There is no military, there's no government behind cryptocurrency. I think that's why people love it so much. The flip side is, though, we just recently had a terror attack in New Orleans last week. What if there was a terror attack where we learned it was financed by cryptocurrency? The United States government could decide to block it at any time. For me, I think the risks of a cryptocurrency are very, very large. I love the technology. I love the scale that it can do, the speed that it can do it. So I'm interested in it, but to put a great sum of money in it, I think is too risky for me. I actually do like some companies that are playing in the crypto space, Nvidia being one, of course, and also PayPal is another one that I like playing in the crypto space. Those are companies where I trust the companies. If Bitcoin were to go away, there'd be another chain that they could implement. So it's not all your eggs in the Bitcoin basket.
All right, Joe, we got to leave it there. Thank you so much.
Thanks for having me.
Coming up, Trump's tariff threats weighing on luxury stocks, while our next guest says the plan could benefit some of those retailers. That's next right here on Catalysts. Luxury stocks recovering after President-elect Trump's potential tariff policies put retailers under pressure. Here with more on how the sector could be impacted by the incoming administration, we've got Jerry Storch. He's Storch Advisors CEO. Jerry, always a pleasure to speak with you. Just talk to me about the impact that you are kind of putting into place right now ahead of the incoming administration, specifically for those luxury retailers.
Truly, I don't see it being as bad as everyone's talking about. No one knows exactly what's going to happen, but you know, I don't think that we should assume the administration is kind of stupid, you know, in what they're doing. This is a thoughtful negotiating strategy on their point. It might even be positive for some retailers in particular, because when prices go up, it depends, right, on what kind of good we're talking about. They have been very successful, all these luxury providers, in passing along price increases for quite some time now. We may see that they're hitting a wall here. People talk about that, but the reality is a lot of these goods kind of have a characteristic. You know, you've heard of a Veblen good, where the demand actually goes up when the price goes up. Some of these look like that's what's been going on. So if the price increases can be passed on to consumers, it might actually not be such a bad thing for these manufacturers. You know, no one knows for sure. I just wouldn't jump to any conclusions here. This is some kind of Armageddon for them.
Jerry, there's certain luxury stocks that you think are better positioned than others given that headwind?
Of course. I mean, you know, and you can buy Hermes, even though the family still essentially controls the business, and they've done very well. It seems like again, people want that at any price, and it's held. And the bags have held their value, and so people believe it. So certainly the companies that cater to the very ultra high-end individual have held up better than the others. Where we've seen a lot of weakness in luxury is in the aspirational zone, where the customers have said, I can't keep paying that. That's like I can buy a car for that, you know, for a handbag, or even like high-end shoes or something, where consumers who used to spring for one every once in a while are going, those are just too expensive. And that suggests we might finally see some trading down here, where there's an opportunity for companies like Tapestry or Capri or someone who's still pretty expensive by most people's wallets, but nothing like the Chanel's or Hermes or Gucci's of the world.
I want to talk to you about some data we got in from Salesforce about the holiday season as well, Jerry. And what stood out to me is this huge rise in returns to the tune of 28% year over year in the rate of returns. Again, that's according to this Salesforce data. You have a lot of experience with big retailers. What would you advise some of these retailers to do to handle just the volume of returns that they're getting and the costs associated with that?
At first, I'm not surprised that returns have gone up. I don't know if they've really gone up that much. You know, Salesforce has their own sample size issues that they're dealing with. It's very clear that e-commerce is gaining share versus bricks and mortar. That's been a theme, it feels like, for a very long time, but it has accelerated over this holiday season, where it's quite clear e-commerce did much better than bricks and mortar. And when people buy things on e-commerce, they don't know what they're buying. They buy multiple sizes and colors and try them on and send back the rest. But the return rate on something bought over the internet is typically double what it is when it's bought in store. So I'm not surprised that this will be going on. So retailers have been working at this for some time, but they have to do a much better job of making it easier for customers to get the right size and the right product. Have you ever bought something online, thought it was going to be this big, and it comes and it's like this big? You know, like, we've all had that experience more than once. So you can't trick people. You're going to end up paying the price with the returns. You have to be a lot smarter. The information you provide, the sizing information, et cetera. And then, you know, you do have to put constraints in place where you can't. You go like, look, I love my customer. They're always right, but sometimes you're taking advantage of me. So on just how many goods they can return or what period. And there's nothing wrong occasionally with, as Bernie Marcus used to say, in firing a customer when they're abusive to you.
Jerry, let's talk about the future of department stores. You and I have talked about this time and time again, and I bring this up just in light of the headline that we got out from Nordstrom not too long ago, the company going private. We've also closely been following the ups and downs that we've seen at Macy's. What does the future of the department store look like? Is it on death's door, or can we see some sort of revival?
You know, it's funny, people talk about that. You've got to put it in the broader context first. They've already sort of died, you know? We're talking about a shadow of their former selves. And even if you look at where the stock prices are, they're consistently where they were 20 years ago or more. And so it's been a dead letter investment for investors in these companies. Meanwhile, they've lost massive market share. It seems like every time there's a report, they feel like, look, we're closing more stores. Aren't we good people? I don't know how that's a good thing, because they're definitely shrinking overall. And then meanwhile, the rest of the market continues to grow. So the market share has shifted in not just a small way, but a massive way into people like Walmart or Costco or TJX, or Amazon. Just massive market share has shifted. So department stores are a fraction of what they once were in terms of their relevance to the retail world. So in a way, they're already died. Now, the next question is, can the ones that still exist, many which have great brand names like a Nordstrom or a Macy's, can they have a bright future? I feel they have to change much more fundamentally than they have so far in order to accomplish that. Nothing's going to change at Nordstrom just because the same family members who owned it before and the same Mexican investors who invested in it before now control it. What are they going to do? Like, oh, before we couldn't do what we had the secret, but we weren't doing it. That's ridiculous, right? So we should expect to see more of the same out of even the best performing players or best, most qualified actors like a Nordstrom, despite the fact that they're going private. And then you have the other companies, and you see what they're doing. You go like, haven't I seen that before? Where they say, we're going to close stores and we're going to have better fashion. Like, haven't you said that like every time you have a new plan, boldest new plan, your super bold new plan? It's all the same plan. And meanwhile, as I said, in a way, in terms of the relevance to the retail economy, they've already died.
Very, very challenging road ahead then for the group. All right, Jerry, always great to get your insight. Thanks so much. Coming up, we're going to take a look at the indicators suggesting that 2025 could potentially be a turnaround point for commercial real estate. We'll discuss next. Federal Reserve Board Vice Chair for Supervision Michael Barr announcing plans to step down February 28th. Now there's speculation over who will be that banking regulator, his replacement. Yahoo Finance's own Jennifer Schomburger has been digging into this for us. Hey, Jen.
Good morning, Shauna. Now that Michael Barr has announced he will be stepping back from the role of the Fed's vice chair of supervision, analysts are speculating that Fed Governor Michelle Bowman could be the natural replacement. She hasn't been selected by President-elect Donald Trump, but analysts say since there's currently no opening on the Federal Reserve Board of Governors until Adriana Kugler's term expires in January 2026, Trump could nominate someone who was currently on the board, and Bowman would be a natural fit. Bowman was actually appointed by Trump during his first term in office in November 2018 to fill an unexpired term ending January 2020. She was reappointed in January 2020 and is currently serving a term that ends in January 2034. Bowman has opposed Barr's plan for higher bank capital requirements known as Basel III. She argued that the plan needed substantive changes and that an increase in capital requirements at the scale proposed by regulators could significantly harm the economy. She wanted the Fed to tailor capital requirements to a bank's size and risk profile, as the regulator does now, arguing that she hasn't seen compelling evidence that changing the approach would bolster the banking system. Though when it comes to monetary policy, Bowman became the first Fed governor to dissent since 2005 against the Fed's first rate cut this past September, arguing she would have preferred a smaller 25 basis point cut rather than a 50 basis point cut because she worried it sent the signal that the Fed saw underlying economic weakness. Yet she voted in favor of a 25 basis point cut in December, despite evidence that inflation remains stuck at the same level this past fall. We will hear from Bowman when she speaks this Thursday. Back to you.
Jennifer, thank you so much. Appreciate it. In the third quarter of 2024, CBRE noted the first uptick in real estate transaction models in over 2 years. Our next guest says this could be a bellwether for the commercial real estate sector. Joining us now, we've got Gregory Cole, Janice Henderson, Investors Global Real Estate PM firm. Thank you so much for joining us today, Gregory. I just want to talk about that uptick in transaction data. What exactly are you seeing and what is it telling you?
Yeah, hi, thanks for having me. I think the transaction data is a really interesting indicator of where we are in a valuation cycle for commercial real estate. So the chart you just showed, you could see those transactions fell off really dramatically during 22 and 23 and started to pick back up into last year. And as you see, fourth quarter of last year, CBRE, who's one of the largest brokers in commercial real estate, reported a year-over-year increase in transactions for the third quarter. Now, what that tells us is that as we saw commercial real estate need to get revalued downwards because of higher rates, that basically has taken place over the last 2 years in most of the privately held part of commercial real estate. And now we're seeing buyers and sellers agree that prices are at a level where they can transact. That is really important to us. I think, we would expect to see that level of transactions further improve in Q4 and Q1. And that's really positive. I think historically, if you look back, when you see that inflection and turn positive in just transactions, it's a good sign that pricing is back on size with where it needs to be.
Gregory, a lot of the outlook here, optimism maybe surrounding CRE and the bounce back that we were hoping to see going forward has been surrounding the rate cutting cycle and what exactly that looks like. We just had the headlines out this morning. Traders are no longer fully pricing in Fed rate cut now before July. Does that at all delay then part of the recovery story that you're hoping to see?
It's an important question. I think at this point, we would say no. So, if we look at the rates, the one indicator I think is probably the most important for this is the 10-year Treasury. And if you look at that, we've been in a range of upper threes to upper fours for the last 2.5 years on that yield. So to the extent that we stay in that range, I think there's no change to that outlook. Now, if rates move materially higher, 5-6% on the 10-year Treasury, that could delay things. But in our view, the spike that we saw in yields, for instance, in just December, is a result of speculation around, policies that might be inflationary, like tariffs, that aren't actually known yet. So as we sit today, and based on the conversations we have with people who are doing these transactions, as of yet, we don't think there's any change to that.
So 30 seconds, you don't see that as very likely for 2025, at least?
In terms of higher rates, I would say at this point, no. Because the inflation, it's all speculation at this point. Your prior guest made a good point about that. We don't know what's going to happen. And if we look at the components of inflation, some of them, like shelter inflation, are actually pretty low on a real-time basis. We think real-time shelter inflation is growing about 1% year over year, and that's a third of the CPI index. So that should have a downward pressure. Other things might have upward pressure. At this point, though, we feel pretty comfortable with our call of an inflection in valuations.
All right, Gregory, thanks so much for taking the time to join us here today.
Thank you.
Keep it right here on Yahoo Finance. Coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. We'll see you tomorrow.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. And on today's show, your tech investments. A portfolio manager discusses the potential risk in your exposure to the Magnificent Seven stocks. And your medical debt will no longer hurt your credit, according to a new rule under the Consumer Financial Protection Bureau. We explain that. Plus, your New Year financial checkup. We'll put the stethoscope to 3 bills that you should review in order to get them lowered. But first, We should mention we are awaiting remarks from President-elect Donald Trump out of Mar-a-Lago. The former president will be inaugurated as the 47th president of the United States on January 20th. Lawmakers officially certifying Trump's election victory yesterday, just 4 years after the same proceedings were disrupted when Trump supporters stormed the Capitol in protest of his 2020 election loss. Let's turn now, in the meantime, to the economy. Job openings during the month of November came in higher than expected and a sign of labor market resilience. My next guest says that the incoming Trump administration 2.0 should lead to better 2025 employment gains. Joining me now, we've got Stephen Risciuto, who is the Mizuho Financial Group U.S. Chief Economist here. All right, so break this down for us, Stephen, as you always do. And what is the comparison that we're running some of those 2025 gains that you're anticipating up against?
Well, I think the answer is very, very simple. When you look at the concerns that corporate America had going into the 2024 period with regard to the potential for the Trump tax cuts to be allowed to expire. Therefore, there was greater pressure on companies to decide that they needed to, hold back on costs in order to grow their earnings. Remember, in 2023, we had an environment where earnings were up only 1.5%, but the equity market was up over 20%. Last year, we're up about 10% in earnings, but we were again up over 20% in the S&P 500. So where there was this desire to really move earnings back into double-digit territory. And now as we're going forward with the prospects of a more pro-business oriented administration with potentially a greater likelihood of additional tax cuts, it takes some of the pressure off companies to control their costs, and therefore it allows them to potentially go back to expanding their businesses and expanding their employment base. And this is what we think will happen in early 2025.
In this morning's job openings and labor turnover survey, we saw job openings a little changed, 8.1 million. And then additionally, we saw the overall number of hires and total separations, a little changed as well, 5.3 million, 5.1 million, respectively. I wonder what picture this further paints around the overall employment situation and labor market from your perspective.
Well, the fact that job openings are starting to climb again, reverse a trend that we have been seeing for several months, and the fact that it's going back up, I think, is an indication of the fact that the transition from, a desire to cut costs to an environment now of trying to go for top-line revenue growth is starting to unfold in the economy. And I think that's important because going for top-line revenue growth really allows for a lot more M&A related activity, also allows for a lot more investment expenditures to come down the pipeline, and allows for an economy to probably put in a fifth year of above-trend economic growth in 2025. And that's a very, very powerful statement. That's the longest period in the post-war environment that we have seen the economy run above trend GDP.
And so all of this in mind, it comes as a precursor to this week's jobs report. Of course, there's a little bit more lag on the JOLTS report versus the employment situation. But what are your expectations going into the monthly print?
Well, we think they're going to be a very, very healthy payroll number. We're in the 170,000 category. We also expect the unemployment rate to stay unchanged at around 4.2%, but we're also looking for 0.4% in hourly earnings. So I think the point here to take away is these are solid labor market environment. The economy is showing that it's keeping a tight labor market environment. We're still below the natural rate of unemployment, which is 4.5%. And therefore, I think it's showing you that the probabilities of additional Fed rate cuts coming down the pipeline is probably being reduced as we go forward into 2025.
So what does that mean for the 2% inflation goal?
The Fed hasn't been able to achieve it. They've opted not to force it to occur. They're more likely to be willing to accept 3%. And I think when they complete their review of the monetary policy goals and guidelines in 2025, they will probably opt for a average inflation target of 2 to 3% rather than a specific 2% inflation target, which means there's still some upside potential in bond yields as the market takes on potentially higher inflation as we go forward in 2025.
All right, Stephen, thanks so much for taking the time here with us. Appreciate it.
Pleasure.
Stocks under pressure today from higher treasury yields. Joining me now, we've got Brian Cronkite, who is the Allspring Global Investment Senior Portfolio Manager. Great to have you here with us, Brian. So you say the Magnificent Seven's weight in the S&P 500 creates risks for investors. So explain those risks and then where you see opportunity ahead.
Yeah, it's a risk of being complacent. The returns of the S&P 500 and the Mag 7 specifically have been tremendous. And we've all been happy looking at our statements over the last 24 months saying how much appreciation we've seen in those 7 stocks. But that's a risk because the market is broadening out right now. Earnings growth rates for these small cap and mid cap companies are accelerating above the rate of the Mag 7 growth rates in 2025, which should put pressure on the spread between the multiples. We don't want to pay as much of a multiple for companies that are growing slower, which is the Mag 7, compared to the broader market, which is the Russell 2000 and the Russell mid-cap stocks. And so complacency with your large cap and your Mag 7 could be a risk. That doesn't mean sell it. Doesn't mean leave. Just be careful about about staying too long, rotate down.
Okay, that's exactly what I was about to ask. As we're thinking about, though, earnings growth rates as well, earnings growth rates between the Mag 7 and the rest of the market, what do you believe that spells out for larger relative performance here?
I think the opportunity here is to understand what's happening with the broader economy. Investors want to be positive on the America First policy that's coming into place. They want to believe that the lower regulatory backdrop and burden will be positive for companies. And typically when that's happening, you want to move your equity down cap. You want to move into small caps, which benefit more broadly from a stronger economy. And you want to move to where valuations are cheaper, which are the value stocks today. But we're not seeing that. And the reason we're not seeing that is because we're fighting against now an unfriendly Fed. Look at the 2-year yields. As that has moved higher in Q4, that's putting pressure, downward pressure, on the market's belief that equities and down cap will rally. So right now it's the battle between policy and Fed, fiscal policy and Fed, and we have to figure out which one's going to win. But if and when the market believes fully that the Fed and the fiscal policy work together, the amount of outperformance of small caps could be meaningful given the discounted valuations versus large cap.
You know, even as you were mentioning that investors want to believe that there is more promise in kind of the America First agenda that is set to really be prioritized among the incoming Trump administration and Trump 2.0 here, there are some major companies that have larger outsized risks. Some of the largest companies in an Apple that get talked about, a Tesla even in their own growth strategy have largely leaned on Gigafactory Shanghai to build out some of what the investors expect to come forward to in the broadening of their own revenue diversification as well. I wonder how you're evaluating that in tandem with some of those very names being Mag 7 names.
It's a great point. It's one more risk for the large cap companies. They haven't had to face it in a long time. The America First focus is going to, by de facto, just put pressure on some of the global supply chains and the global customer bases that these larger companies have. Not all companies have this condition, but as you move down cap, you're more likely to see companies that have a higher percentage of revenue coming from the U.S. client base. And so it's a positive there for small caps as well. So global companies have to be very careful about the likelihood of their supply chains being disrupted and the opportunity for their customers to have to face different tariff structures or just higher prices in general.
Where are some of the sector opportunities that you believe are set to prevail or outperform in 2025?
Well, I'm a little cautious on banks. To start where I'm not excited, because the market's very excited about banks right now. I'm very concerned about the market's optimism around small cap and regional banks in particular. The large cap banks have material competitive advantages that are not going to go away. In fact, they're going to get stronger as CCAR potentially is removed and the regulatory backdrop changes. So I think the optimism around banks, down cap, is a bit nerve-wracking for me right now. Conversely, where I like to go right now is I want to push that capital into materials, where we've seen some of the packaging names, some of the chemical names go under extreme pressure over the last 12 to 24 months. And I'm also seeing opportunity in healthcare. Healthcare has gone through a tremendously negative rhetoric as we've gone through the election cycle, and valuations there look really attractive to me. And these businesses have stable cash flows that are nowhere near as volatile as what the market's reflecting through stock prices today.
And what about individual names? Who are you tracking? What's at the top of your list in terms of the companies that you're piling into to start the year?
Well, 2 names I like, sticking with the sectors we just talked about. Graphic Packaging in the material space is a packaging company going through a multi-year transition. They're on the very tail end of that right now. That transition is going to see an improvement in the stability of cash flow because they sold off their more commodity-like assets. You're going to see a growth in the margin structure as they focus on value-based pricing. And you're going to see expansion of their capacity as they complete their big CapEx program in Waco, Texas. And so Graphic Packaging to me is a company going through a transition the market hasn't fully appreciated yet. On the healthcare side, Charles River Labs is a business that we like and believe that the clinical research organization companies in general are underpriced today. CROs are companies that help pharmaceuticals and biotechs get through the clinical testing phase. And we've seen a pullback on money spent on R&D and testing as pharma companies have merged and as interest rates have moved higher, putting pressure on available capital. That is not sustainable in the long term. These companies need to invest to develop drugs, and that will continue to happen again. Charles River has been investing through this trough in their cycle, which we think positions them well to have a much bigger market share and ultimately bigger cash flow streams as we get to the other side of this downturn.
Bryant Van Cronkite, thanks so much for taking the time here with us today. Appreciate it.
Pleasure.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got my morning brief co-host Shauna Smith back here live in living color in studio. First up, we got to talk a little Aurora here. That one has been lighting up the trending ticker page on Yahoo Finance. Aurora Innovation rallying on partnerships with Continental and Nvidia to deploy driverless trucks at scale here. Shares, my goodness, Shauna, moving up by about 37.5% right now.
Yeah, it's crazy to look at this astronomical climb that we see from Aurora Innovation. But when you pair it with the excitement surrounding Nvidia, maybe it's to no surprise that we are seeing the degree of reaction that we are here right now in early trading. Let's talk about what exactly this partnership entails. So this is with Aurora, Nvidia, and then also there's a third company here involved in this, Continental. They're a tire and car parts supplier, and they're all teaming up for driverless trucks. And this is the future here. Lots of excitement surrounding what exactly this means here. Nvidia's Drive-Thru platform and Driver OS is going to be incorporated into this driverless system. Now, we'll take some time here in order to get this up and running, but the CEO of Aurora, Chris Umson, was very, very encouraged and optimistic about this partnership, saying that, quote, delivering one driverless truck will be monumental. Deploying thousands will change the way we live. And I think it's that last line, changing the way we live, really speaks to some of the excitement, some of the technological advances that we're getting out of CES and explains the massive jump that we're seeing in a name like Aurora today.
All right, let's go to the stretchy pants industry, why don't we? Lululemon upgrade to outperform from market perform at Bernstein. Analysts citing a stronger 2025 with an inflection point in growth in the Americas business pegged to a stronger, higher income consumer and easier comps as well here. Shares of Lulu, ticker symbol LU, very fittingly. That's up by about we'll call it 2% roughly on the day.
Yeah, the product pipeline, I mean, you listed off the big factors here within this upgrade and why Anisha Sherman, the analyst at Bernstein, is a little bit more optimistic or much more optimistic when it comes to Lululemon. A lot of this has to do with the bottoming maybe of the Americas business. She does see a catalyst here ahead, a lot of that coming from the product pipeline, saying that a better 2025 spring assortment is going to help reignite some of those sales that have been lagging just a bit. But it's not just about the trends that we're seeing here in the U.S. She was actually very encouraged and bullish on the trends overseas in China. And that, to me, is important to note, just given some of the concerns surrounding the Chinese consumer and some of the buying patterns that we have seen there. And within this report, I also want to point out that Sherman it's not only Lululemon that she's optimistic about within the sportswear spending space, it's also beyond that. She highlights that she is bullish here on the entire sportswear brand coverage. That includes top picks like Adidas, Nike, and On Holding. So she's seeing a return. She's confident here in the trajectory of consumer spending, where that's going, and Lululemon just one of the names that she sees benefiting from that cycle.
I just got a Lulu parka. I quite like it.
Did you? Well, then you're contributing to it.
I'm helping. I'm somewhere within those financial results.
They're Align leggings.
Yeah?
Yeah.
Okay.
My favorite purchase.
All right. Interesting. We'll see if it continues to resonate in China as well. That was up 39% in the most recent quarter. Also here, finally, let's round this out with JP Morgan Chase. JP Morgan Chase is reportedly planning to bring all employees back to the office 5 days a week. This is according to a Bloomberg report. And we're taking a look at shares right now, up by about 1.5% here. I mean, digging deeper further into this also has been an employment attrition play that we have talked about too with companies.
Yeah, I don't think this is any surprise, just given the rhetoric and what we've heard from CEO Jamie Dimon in the past. He's made it very clear that he believes many of the best work is done when people are collaborative and people are in one location in the office here. So again, we are expecting this announcement to come in the coming weeks, and this would replace the current 3-day mandate here for many workers. Remember back in April of 2023, so almost 2 years ago, that is when JP Morgan came out demanding that all MDs, managing directors, had to be back in the office 5 days a week. When you zoom out even further beyond that, about 60% of the bank's staff, and that includes traders, retail branch workers, the MDs I just mentioned, they're already operating under that 5-day-a-week requirement. So again, this would encompass the rest, the 40% here of the workforce that maybe is not mandated to be back in the office 5 days a week. I also want to point out that we have seen a divergence here just in terms of how these top Wall Street banks are approaching this. When you take a look at a name like Citi, a little bit more flexible under CEO Jane Fraser. We know that Goldman Sachs under CEO David Solomon, he's been very vocal and really has pushed staff to be back in the office now for quite some time, 5 days a week. So we will see how this all plays out at JP Morgan.
Well, the locations of these offices are changing too. I mean, JP Morgan had even announced last year at the midpoint, I believe, that they were going to expand their Miami office, knowing that there were so many of the employees that were like, all right, cool, if we don't have to be in the office 5 days a week, I might just move to Florida or find somewhere else that might be, well, at least at the time, a little bit cheaper, maybe have some better tax benefits. And that's certainly something that the banks have perhaps been in a little bit more constant communication with their employees about, especially as they were saying that they're looking to double the size in that Miami office.
Yeah, well, and they also invested a heck of a lot of money in their new headquarters here in New York City as well. And that project was underway before the pandemic started, and so continues today. So I don't think a big surprise there.
Yeah, somebody's got to be there to have the free snacks. Why not? Shauna, thanks so much. Appreciate it. Coming up, everyone, your medical debt will no longer be a consideration in your credit report. We'll explain. Plus, examining some of the biggest consumer spending themes for 2025. More on wealth after the break. The Consumer Financial Protection Bureau, or CFPB as you know them in your hood, announcing today a new finalized rule banning unpaid medical bills from being included on Americans' credit reports. Here with the details, we've got Yahoo Finance senior reporter Jordan Weissman. Jordan, what do we know?
Yeah, this is a high priority for the CFPB under Director Rohit Chopra. They've been working on this rule since the summer, and they've been kind of dealing with this issue of medical debt for a while now. This particular regulation was something they put together kind of in partnership with Vice President Kamala Harris, who was very interested in medical debt. And what it would do in theory, if it's ever implemented, is it would ban credit reporting agencies from including your unpaid medical bills, your unpaid hospital and doctor's bills that have gone to collections on your credit report. And this is sort of the continuation of what's been a gradual process. The credit reporting agencies like Experian, TransUnion have already agreed in recent years to limit their use of medical debt in credit reporting. For instance, they already agreed to not include medical bills that were less than a year old. They agreed to not to include medical bills that were under $500. Oftentimes because patients would get a bill and then contest it, dispute it, and it was sort of unfair or in a lot of people's view, for people to have that then kind of tarnish their credit. So this could be a big deal that this is now a blanket national ban that would be in place that would say no medical bills, no medical debt would impact your credit.
Jordan, thanks so much for breaking this down. Next time, perhaps we could do this over some sick baselines. Appreciate it.
This sounds good. Thanks.
Right, thanks. MasterCard Economics Institute is out with its outlook for 2025, and it has some key insights about consumer spending. This includes spending on big-ticket items, travel, mass market versus high-end apparel, and the she-economy. Here to dig into some of them, we've got Michelle Meyer, who is the chief economist at the MasterCard Economics Institute. Great to have you here in studio with us, Michelle.
Fun to be here.
We got to dive into some of these expectations, and we'll start with the big-ticket items in 2025. What are the anticipations there?
Yeah, so when we think about overall trends in 2025, we're looking for the global economy to expand 3.2%, which is a little bit above the trend that it saw in 2024. General continued outperformance in the U.S. here with this exceptionalism story continuing. We saw the momentum from 2024 with the holiday shopping season coming in strong. And we continue to see an environment where consumers are going to be actively participating and engaged in the economy. India is another story, another economy that is still shining bright given some of the structural changes that have been very favorable. And the GCC, when you think about some of the dynamics in the Gulf, where there's, again, a narrative of not just growth in the short term, but potentially continuing into the longer term.
One item that I really liked within this report, and it's reminded me to schedule my days off, I really liked the travel wins here.
Yeah.
All right, or travel twins, I should say. Travel twins, what exactly does this entail?
Sure. So there's a lot of focus on the travel economy, as there should be, right? Coming out of the pandemic, all of that pent-up demand to get back out, to have experiences, to travel, to see the world again after not being able to. But, you know, when you think about how consumers are choosing where they're going and why they're going, affordability matters, and convenience and the ability to get to certain locations matter as well. So we looked at some of the big areas that people travel, and then we matched to their quote-unquote twins. Those locations that are not as actively visited, maybe more affordable, more reachable. And it's fascinating to see these trends where the twins last year in 2024 saw faster growth in hotel spending, and we think that that should continue into 25 as consumers are really mindful of how they're spending and again, why they're spending and how they get the best value.
Okay, so just to pause for a second and spend a beat on the spending on the experience economy and spending on services versus the goods spending and those big ticket items that we were talking about. Are we anticipating that people will spend more on big ticket items this year, even knowing where travel has been valued as well?
Yeah, so we do think that there'll be more of a balanced budget as we look at balanced basket, I should say, as we look at into 2025. And we saw some evidence of that in 24 in the holiday shopping season, where categories like jewelry showed a lot of strength, electronics, certain technology items, where the combination of promotions and frankly the replacement cycle likely mattered for those categories. But I do think it's the experiences that were so important to the consumer the last few years. It's still the case that that's something that's valued. It's just that consumers are being a little bit more mindful around how they're spending and engaging, because we know that price levels have increased. It's expensive to go out and travel. You still want to do it, but you want to do it where you get the most amount of value. So overall, yes, a bit more balanced basket market than maybe we saw early 24 and certainly in 23, but one where consumers are still engaging with that mind of how they get the best value.
So one of the other things that you identified is mass market versus high-end apparel here.
Yeah.
And this perhaps ties back into the kind of balling on a budget that you were just mentioning a moment ago. What are you seeing there, and how is the consumer mindset shaping up?
This was a really fun analysis. I'm glad you brought this one up as well, because given the nature of our data and the fact that we're able to have such granularity in terms of spending across different categories and across different countries, we looked at 26 countries, and we're able to categorize spending on mass market versus these really uber luxury names, like, so think really luxury. And in 85% of the countries, we saw faster growth in mass market than we did in the luxury names. The exceptions being Mexico and Japan, where luxury spending outperformed. In a place like Japan, that can make a lot of sense given the amount of tourism that moved in with the strong dollar relative to the weaker yen, a lot of international visitors that were out there spending and embracing the luxury market there.
Interesting. Okay. While we have you here, we got to talk about the she economy. I mean,
yeah.
You think a couple summers ago, and it was Taylor Swift, it was Beyonce driving the she economy and the experience economy. Then, are we looking for a resurgence, a reboot, if you will, in the she economy?
Yeah, I don't think the story has gone away. I just think it continues to transform the she economy and how you think about it. So of course you have these phenomenon, as you mentioned, T Swift, that are taking over in terms of how people are spending and engaging and creating a lot of life into the economy. But I would also argue that the other dynamic that's fascinating that we explore in the piece is the engagement of female workers in the labor market. So across, again, the global economy, a very clear theme was that the participation rate for women aged under 54, so kind of that cyclical dynamic of the workforce, we had a much faster increase in participation amongst the women of that age than men, and that was across many different economies.
Michelle, we got to leave the conversation there. We have some breaking news coming in. We go now live to President-elect Donald Trump speaking at Mar-a-Lago. Let's listen.
Thank you, gentlemen. And I'm thrilled to announce today that DMAC will be investing at least $20 billion over a very short period of time into the United States, and they may go double or even somewhat more than double that amount of money. It's a great thing, and I believe he will say that he's doing it because of the fact that he was very inspired by the election. They wouldn't do it without that election, I can tell you. A lot of people wouldn't. You saw last week where we have somebody who's going to go from $100 to $200 billion, and we have many other people, and we'll be bringing some of them out. Some of them like to do it somewhat more quietly, and some don't, and they feel so strongly about the country that they want to let people know about it. But it's an honor to have such a great investor investing in our country. The investment will support massive new data centers across the Midwest, the Sun Belt area, and also to keep America on the cutting edge of technology and artificial intelligence. He's very big into the data centers, and that's going to be a very hot item in the coming years, as you know, with AI. In particular, the first phase of the project will be in Texas, Arizona, Oklahoma, Louisiana, Ohio, Illinois, Michigan, and Indiana, those places. And Hussein, I'd love you to come up and say a few words. Thank you very much. Thank you. Thank you.
Thank you, Mr. President. It's been amazing news for me and my family when he was elected in November.
All right, that is President-elect Donald Trump addressing the nation from West Palm Beach, Florida, ahead of his inauguration, less than 2 weeks away. We'll continue to monitor the remarks here and bring you any updates, especially as it does move any markets here. We'll continue to discuss that on the other side. We'll be right back with more wealth on the other side of the short break.
It's time for Yahoo Finance's Market Minute. Stocks reversing earlier gains as investors weigh new economic data and curve rate cut bets. Early on Tuesday, the Institute for Supply Management's manufacturing PMI indicated prices paid jumped to a nearly two-year high, a sign that inflation pressures continue to persist. Meanwhile, mixed jobs data pointed to a cooling labor market with more job openings and less hirings during the month of November. And in corporate news, Meta is ending its fact-checking program on Facebook and Instagram. CEO Mark Zuckerberg saying the company is going back to its roots around free expression. The company is also adding new members to its board, including UFC CEO Dana White. Plus, Nvidia reversing earlier gains, now down over 4% after hitting an all-time closing high following Jensen Huang's keynote at CES. The chip giant announced new autonomous vehicle partnerships and plans for AI that can be used to power humanoid robots. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session. Stay tuned for more wealth when we return.
We go now back to President-elect Donald Trump, who was speaking at Mar-a-Lago just under 2 weeks before the inauguration. Let's listen in.
Looking like a bunch of fools with 13 dead and many, many badly, horrifically injured. Nobody ever talks about them. No arms, no legs. Nobody ever talks about them. The way they got out was outrageous, leaving billions of dollars of brand new military equipment that I bought in the hands of the Afghans and specifically the Taliban. It's the group. And we were doing very well. We would have been out. We would have been respected. I think it's one of the reasons it was so badly handled, that withdrawal, where people are jumping onto airplanes, falling off the sides of airplanes when they're 3,000 feet in the air. And nobody's ever seen anything like that, the worst. And because of that, I think Russia went and attacked Ukraine. When they saw that, they said, these guys are incompetent. They don't know what they're doing. But we know what we're doing now. And that's going to all end. And we have a great military. I defeated ISIS, as you know. We're in no wars. I just finished a couple. And we got also our soldiers guarding Syria and Turkey. We're in the middle. We had 5,000 soldiers there. Would have been gobbled up with two armies.
Okay, that is President-elect Trump addressing the nation from Mar-a-Lago ahead of his inauguration, which is less than 2 weeks away. We'll continue to monitor the remarks. Turning now to one of the biggest tech conferences in the world. Our next guest joins us from CES, where she says that the defining theme of this year is AI, everywhere and in everything. And it's getting better at anticipating your needs and making your life easier. Wendy Sheehan-Donnell, who is the PC Mag editor-in-chief, joins me now. Wendy, great to have you on the program with us with the backdrop of CES there. Why do you think that this is the definitive thesis statement for CES this year? Wendy, we're going to try and get your... Oh, there we are.
There I am. I'm so sorry. I'm so happy to be here. Thanks for having me. Yes, I have CES behind me, and it's so exciting because, yes, AI is everywhere and in everything, which was sort of the theme of CES last year, but it's a lot bigger and better this year.
So you've also highlighted 3 key ways that artificial intelligence will more often than not, and most certainly is expected to influence some of the major products that consumers are going to be buying into over these next several years here and might actually be put into consumers' homes here. So what are you anticipating there?
Absolutely. So we're going to see a lot of AI in your home. Samsung, for example, I saw yesterday is showing an oven that basically has cameras and AI and uses it to see what's in the oven, helps you create recipes. A camera in the oven lets you see how your food is cooking, create a time-lapse video of what you're cooking so you can post it on social media. Hisense revealed the smart refrigerator that basically has a camera inside. And I don't know if your refrigerator is anything like mine, but it's very messy in there. But the camera uses AI to determine what's in there to create a shopping list for you and menus. Really exciting. One of the more fun things we saw yesterday was a robot vacuum from Roborock, which robot vacuums are very smart with AI now already. But this one has an arm that will, if it sees a sock or a small toy in front of it, the arm will pop up and pick it up, and you can program it to put it away for you, and then it continues cleaning your house the way that it would have. So smart home all over the house.
Sounds like our refrigerators have a lot in common, Wendy, and we're looking for a lot of these smart products for sure here. As you're thinking about some of these smart products, the price point, does it seem like we're getting any clear indication about how much this is going to cost consumers for these innovations?
Yeah, I mean, at CES, almost nothing comes with a price at CES, right? Because it's really early on. Some of these things will come out this year, and we'll be reviewing them on PCMag.com, and we'll have pricing, and we'll evaluate that in our reviews. But a lot of stuff is just here to show you how cool and exciting it is, and not to tell you how much it costs. But I will say, as AI, chips and AI gets more prevalent and chips get cheaper, things get less expensive. I'm not going to say that fridge or oven are going to be that cheap, though, honestly.
With all of this in mind, beauty and health tech has really taken more of the kind of viral moment or the virality at some of the years past CES. Have there been any of those key moments that you've seen really be talked about either on the exhibition floor or among some of the executives there?
Yeah, like the show's floor is not even open yet. It opens today at 10, but we've had a lot of press briefings, and saw a really cool fitness mirror from a company called Y.NYB. So you stand in front of the mirror, it's got sensors, it sort of sees what's going on in your body and tells you about your lung health, your heart health, how you're eating, how your general fitness is. And then it uses AI to sort of talk to you and give you plans, health plans. And also they see it as like, your doctor could eventually hook into this and help you, assess your health without having to go to the doctor. That was pretty cool. And another cool thing I saw yesterday from L'Oreal, which is, a middle-aged woman like me, kind of an interesting thing. It basically, it's a system that takes a swab, takes cells from your cheek skin, your skin on your cheeks, and tells you the sort of health of your skin and the products that you could use to make your skin less aged.
Interesting. Okay. All right. I might be a buyer of some of these things. Wendy, appreciate the early preview here. And of course, we're going to be checking back in with some of the updates from our own reporter out there at CES as well. Wendy, thanks for taking the time.
Thank you.
Certainly. Well, it may be cold in the Northeast, but that's exactly where the housing market is heating up, according to Zillow's predictions for the top 5 hottest markets in 2025. Zillow puts Buffalo, New York at the top of the list for the second year in a row, followed by Indianapolis, Indiana, Providence, Rhode Island, Hartford, Connecticut, and Philadelphia, Pennsylvania. Zillow's outlook takes into consideration several factors such as home value growth, the speed homes are selling, and job growth per new home permitted, and expected growth in owner-occupied households. Now, there was some potentially good news for buyers. Home value appreciation is set to slow down in 2025 compared to 2021 and 2022. But according to a new survey from Redfin, a third of current homeowners say they have no plans to ever sell their home. And over a quarter say they won't consider selling for at least 10 years. That, paired with high mortgage rates, mean potential buyers will still be facing a challenging market in 2025. Coming up, 3 bills you should review as part of your New Year's financial checkup. Plus, we've got some tips on lowering your household spending in 2025, one coupon at a time. A programming note. In this week's episode of Decoding Retirement, host Bob Powell speaks with Fritz Gilbert, who's the author of the Retirement Manifesto blog, about how to find purpose in retirement.
If you're in retirement, you've made it, you're successful, you've achieved it. It's a really good time in life to start looking at people that maybe haven't made it yet, people that are struggling, and finding a way to use your time to benefit those in need. That's a really rich area to look at, and that's what our charity focuses on. I would argue some of my writing focuses on that. It's people that haven't yet retired. It's a way to help people that are still trying to figure it out. That's others focused, right? So the more things you can find that are focused on others, that's generally a really a good path to look if you're trying to figure out what you want to do in retirement.
You can catch Decoding Retirement Tuesdays at 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. A new year means a new budget, and our next guest recommends reviewing all of your monthly payments and seeing where you can trim. Joining me now, we've got Winnie Sun. She is the managing director at Sun Group Wealth Partners. Winnie, great to have you back on the program with us. You say that lay out these three bills that people could see some relief in, and streaming services, your Wi-Fi bill, and your cell phone bill. That's what you lay out here. Let's start with streaming. How can people cut back on their bills there?
Yes, Brad, thanks so much for having me. Streaming service. Yes, I say you want to embrace the toggle. And why I say this is so many of us have more than one streaming service. But as we know, life is really busy. We don't really have time to watch everything on one streaming service. So instead, I would suggest canceling one streaming service before signing up for a new one. And then instead repeat this every 6 months or at least quarterly. And you can just put this into your calendar 15 days prior to the monthly renewal date. And this will help you rotate your streaming platforms. You can actually decrease your streaming costs now by like 50% or more, depending on which ones you subscribe to.
And so how can you lower your internet bill? This is another key area that you focus in on.
Yes, absolutely. So often, internet prices will change depending what providers you have in your neighborhood. And a lot of internet and cable bills often include a lot of extra things that you don't really need. So first things first, you can research online to see what options are available to you in your neighborhood. You can also go to the company's online chat. This is one of my favorite things to do. Just jump in. You can be in your pajamas. Jump into chat and just say, tell me about any specials you have or anything that's available to me. And it doesn't hurt to ask. It might take you 5 minutes and that may give you a discount even for a few months. And that's great. And also think about downgrading to a cheaper plan if you're not really using your entire internet usage. So maybe your usage is lower and you've been busier at work or whatnot. You can always increase later if you find that it's not enough, but at least it'll save you some money in the meantime.
What about lowering your cell phone bill?
So this is a big one. Cell phone bills, we know, are often actually one of the culprits of being very, very bloated with unnecessary services. And so there's a lot of great discount plans available to you. There's budget-friendly options such as Mint Mobile. You've probably heard of the ads on that. But also prepaid plans is a sort of a sweet spot. A lot of times when people spend money on prepaid plans, they can save as much as $50 to $150 a month, depending on how much they use. And you should also take a look at this. If you just can't manage a prepaid plan, you can look at joining or creating a household plan. While many of these are considered family or household plans, most cell phone companies we have found are marketed as being for people living in the same house, but most carriers aren't really strict in terms of enforcing this rule, which means that you could actually join a plan with people who don't share the same residence as long as they're being considered part of your household. You just want to make sure that everybody is responsible and will pay their full share, but that's something you might want to consider if you have roommates, close friends, even extended family members.
All right. While we have you, Winnie, broad budget tips for the new year. What are they?
Okay, budget tips for New Year, probably the biggest one is go to your email account and unsubscribe to all those retailer emails. You don't need it, right? You don't need those sudden sales or coupon codes. If you need it, you can look for it in the future. You can be proactive on that. Really focus on needs versus wants, and most importantly, find a money buddy that you can talk money savings and lifestyle with, and that will really help you throughout the year.
All right, I'm going to get a lot of those we hate to see you go response emails when I unsubscribe from all the retailers that I get the discounts from. Winnie, thanks so much. Appreciate it.
Thank you so much for having me. Take care.
You too. The number of digital coupon users is steadily growing in the U.S., according to data from Statista. The majority of Americans find their coupons either through email subscriptions or online searches. And our next guest is an online coupon hunter with more than 3.5 million TikTok followers. Kirsty Torak joins us now with her tips on couponing. Kirsty, great to have you here on the program with us. So where do you find your coupons? Let's start there.
So thank you for having me, first of all. Where you find them is pretty much on any store apps. You can pick your favorite store retailer, go into their app, and 9 times out of 10, there will be a digital coupon section. You'll be able to search the coupons for the things that you normally shop for or new deals that have popped up throughout the week. But every single platform most of the time, 99% of the time, we'll have a digital coupon section for you to just clip coupons and save money at the register.
Okay, I'm learning a lot of new terms this holiday shopping and post-holiday shopping season. And I learned bracketing already, and that means essentially buying 3 of the same item maybe and then sending back 2 items that don't fit. But now I'm learning about stacking. What is coupon stacking?
Okay, so coupon stacking is just basically a term that we say to get the most bang for your buck by stacking multiple offers into one purchase. So what you're going to do is you're going to take a store sale, a coupon, a store reward, and then ideally a rebate and stack all of those savings into one item to get that item for the cheapest price possible. It's possible at many Target, CVS, Walgreens. Because they offer store rewards on top of digital coupons, you're able to stack their sales with all of those offers to get things for oftentimes free or pennies on the dollar.
Okay, like free. So what are some of the most common items that you can kind of coupon shop for?
I mean, basic any household essentials, you're talking laundry detergent, paper products, toothpaste is always free, body wash, deodorant, all of the basic like household essentials and beauty items are gonna be possible to coupon for a minimum of 50% off every week. The harder things to coupon for are gonna be grocery items because those fluctuate in price. But I mean, anything that's not a food item is always, always, always gonna be couponable every single week.
What are the best stores that you find kind of roll out the most consistent coupons that can be redeemed?
Yeah, so Target, always, every single week. CVS and Walgreens, really big into couponing. Dollar General, another great store, every single Saturday has a deal because they run their 5 off 25 coupon. All of those stores are constantly cycling new deals and new cycles for you to save with.
You know, while we have you here, and you may have heard our last guest say that it's time for me to unsubscribe to a lot of those retailers who send me the discounts and the deals that hit my inbox on far too frequent cadence, and that's for them to work on their email marketing strategy for. But me on the other side, I'm sitting here like maybe some of these will come in handy. I imagine that you might have a rebuttal to unsubscribing from all of those.
All of them, yes. I definitely think that the frivolous spending, 100% unsubscribe from the frivolous spending. But if you're talking about groceries and household essentials, those are things you're going to buy anyways. So why wouldn't you want to save on the things that you have to buy? Don't unsubscribe from places like Target, CVS, Walgreens, Dollar General. They're going to give you their weekly ads and their coupon deals every single week right to your inbox so you don't have to go searching for them. But I 100% agree. Please do not go unsubscribe from the things that you should unsubscribe from. But, you know, necessities are necessities.
Certainly. Just lastly, while we have you here, if someone was to set a goal for how much couponing could or should save them in 2025 and hopefully stick to that goal, what percentage is a good kind of just, you know, marker to put out there for their own way of thinking and perhaps applying to their smart spending?
I would tell you, you can cut your budget in half every month if you just start couponing. My mom always told me life by the inch is a cinch, life by the yard is hard. So if you start small and you kind of snowball it throughout the year, you're going to see bigger savings as you go. But if you're just looking for a coupon, take 5 minutes before you get to the register and scan your items in your cart to see if any deals and offers are available. You're going to save money 99% of the time, and it took you 5 minutes to do it.
All right, ask your mother if we can borrow that quote. We will have to fire up the Yahoo Finance t-shirt maker. Kirsty, thanks so much for taking the time.
Thank you for having me. I really appreciate it.
Likewise. President-elect Donald Trump is speaking live at Mar-a-Lago. He is just about 2 weeks before the inauguration, and he announced Dubai-based property development company DAMAC is investing about $20 billion in the U.S., and the money will go to building new data centers across the country. Trump explained the first phase of the plan will take place in Texas, Arizona, Oklahoma, Louisiana, Ohio, Illinois, Michigan, and Indiana. The president-elect also commenting on the state of the economy. Take a listen.
Inflation is continuing to rage, and interest rates are far too high.
Yahoo Finance will be doing special coverage of the inauguration on January 20th, so stay tuned for that. Let's do a final check of the markets with the time that we have left here. We're taking a look at the major averages on your screen. Don't worry, we'll get them loaded back up. Fractional declines for the Dow and the S&P 500. And the NASDAQ, you're seeing that down by about 1.5% as of right now. Of course, we're continuing to keep close tabs on any comments that are coming out of the Consumer Electronics Show in Las Vegas. That's where Jensen Huang, the CEO, took the stage last night, certainly got a lot of juices fired up and flowing, and that is playing out in Nvidia shares here on the day here as we've been tracking shares of NVDA. As of right now, I'm taking a look at the stock, actually down by about 5%, even though we did see a new all-time high here to begin today's trading session. We have moved off of that. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. Stay tuned for Market Domination. That comes up 3 p.m. Eastern Time.